Okay, welcome. Round the Clock Trader, March 2023. Thank you for being here with us. My name is Simon Campbell from IX Media. We publish these Round the Clock Trader events every couple of months now. We're doing 2 days. We've got 17 fabulous speakers, traders with hundreds of years of experience. I know I'm aging them all when I say that, but it does add up to 400 years worth of trading experience in the market, some of them in professional capacity, some of them as independent traders, having done it as a side income earning process, and now becoming full-time, not becoming professional fund managers off the back of that. So all sorts of different topics, looking at charts, looking at technical analysis and fundamentals, looking at stocks, looking at picking stocks, swing trading, day trading. Really, there's not much I don't think we'll cover, but if there is, do let me know and we can find someone to speak about it. So I'm really pleased you're here. Welcome. Do let us know with that chat box where you're joining from. It's always interesting to know where the audience is from, and also let us know just an indication of maybe how long you've been trading, if at all. We're welcoming people who have never traded before or those with lots of experience. There's a huge mix of talent here watching and tuning in, as well as us speaking and talking about our experiences. So do use the chat box as much as you can. And in fact, I'll ask you to use it just very quickly now to let me know that you can hear me. So you should be able to see myself, and our first speaker, Cameron Malik, is one half of a company called Magnetic Trading. And Cameron is here again because he joined us last time, which was fabulous. It was a great talk, a talk that actually inspires quite a lot of conversation because it's something that not many traders that we've been doing these webinars. Thanks, Graham, Sterling, everybody knows who can coming through loud and clear. Seasonality trades, first of the month trades. These are talks. These are trades that Cameron has used over many years to amass capital, and it's a system, it's a strategy that can take a lot of stress out of the sort of day trading aspect. This tying yourself to the screen and watching the markets tick by tick. This is a different approach and something that nothing in trading is guaranteed, but it has a high probability of success. So it's something to look out for. And we're going to talk about that for this next hour. We've got a whole schedule of people coming to speak to you today, and I will go into that maybe at the end of Cameron's session. If we've got some time, I'll just run through the different speakers. But first of all, Cameron, good morning. You're here. Welcome. Thank you for joining us again.
Good morning, Simon, and good morning, everyone. Yeah, lovely to be back.
I will just turn my volume up. I assume everybody can hear Cameron as well. Okay. Shall we just share the screen like you did before, Cameron?
Sure. Let me do that.
So we've got Sterling back from Detroit in Michigan. Welcome. Thanks for coming back to join. It must be early for you, I'm guessing, or it's been a late night. But you're a scalper. Great. Okay. So we've got some scalping speakers on. Harry Boxer, actually, a fellow countryman of yours, joining us tomorrow towards the end of our day. Have you come across Harry Boxer before? The tech trader. He's day trading and scalping. Okay, so we should be looking at the yellow slide, index trading specialist, market specialist, and market function. Can you all see the slide? Great. Okay, so Cameron, where should we get started? Do you just want to give us a bit of background, because you haven't always been in the financial markets. You ran lots of different businesses. I think you've exited from these businesses and put some money into investing, but more or less self-taught how to manage your own money. Is that a?
I don't think anyone can be fully self-taught.
No.
I think that road could be very, very long. But yeah,
You had some mentors.
yeah, definitely, definitely. I mean, I started out in business when I was 20 in wholesale, and grew that business from the small town of Edinburgh to sort of
Which I know
becoming
very well.
that you and I know very well. Yeah,
Hail
we're
from the same place, yeah.
exactly. So yeah, for those of you who don't know, we're both from Edinburgh, Scotland. And yeah, I started that route and got into distribution and grew that business to supply a lot of the major convenience stores and wholesalers in the UK. And essentially, I was pretty much trading ultimately at the end on commodities like Coca Cola, Red Bull, Pepsi, water, Volvic, and so on, and moving that from Europe into the UK. And that's really where my trading journey kind of began. Now, thinking back over 20 years ago, because if you think about it, Simon, we were buying in euros and selling in pounds,
Yeah.
and often a lot of these orders for containers, say for example, Iceland supermarkets we used to supply. They wanted 46 containers of Capri Sun, and they wanted over a 3 month period. So what I would have to do is buy currency options uh, to hold the price. And that's where it all really began a long, long time ago.
Yeah.
And the logistics of moving containers from Europe into supermarkets when you have a 20-minute delivery window can cause some havoc. And that's when I thought, look, why don't I just, I'm doing the same thing. I'm buying a commodity, if you like, at a price and selling it at a higher price. Why don't I just move this all to be, fully digital and not have to deal with the stock and all of the real incumbents of business? And I think just to kind of maybe talk on that really, I don't know, many people get into business to be free. And I found certainly after 7 years of being in business, I was probably the least free person I knew, having staff, offices, vehicles, warehouses, and all of the legislation that you have to deal with. And they say that business is one of the greediest lovers, and that's where I tell everybody that trading is certainly the best business in the world. I think that's why we're all here, because it does give us the ability to trade from anywhere in the world. Now I live in Asia. We don't have any stock. We don't have any staff. Not many businesses you can be liquid in. You can't really pack up a big wholesale operation and have your cash in at the end of the day. And we sort of very, very fortunate to have that in trading. So that's why I made the move, and that's why I'm still here, really.
Fantastic. Well, I mean but that's more or less 20 years since you started trading full time, or
Yeah, I mean, yeah, I was trading. I guess I was trading containers, if you like, back then. So probably more than 20 years, and then just moved it into the markets.
got rid of the containers and carried on doing the trading. Yeah. I mean,
Yeah,
it is great. I mean, a lot of people, small businesses, friends of mine, they just the pressure's on, particularly in the UK. They feel as if they're just running the business to collect tax for the government. It's very difficult. Corporation tax going up and all sorts of things. So that is why trading is a great thing, either as a side income, or if you can full time. It's interesting. I mean, we'll talk about this more throughout the next couple of days. It's not as easy to do trading full time, though. And Cameron, you'll know all these issues. Psychologically, you deal with highs and lows and winning days and losing days, and doing that on a full time basis can be challenging. And I think that's where a lot of people come here, is to hear people like you. How did you sort of overcome it? How do you avoid maybe some of these pitfalls getting started? I see Rosie, welcome. You just haven't started trading yet, and Graham's been at it for 20 years in the west of Ireland. So we've got a mix of experience, and it's always useful for everybody that's here to sort of pitch in with any experience or anecdotes that they think might help as we go through. But Cameron, I'll hand over to you now because I know we've got a presentation which is very interesting to learn about these different trade strategies. Time is always ticking away, so let me hand over to you, and I'll let you go. And if there's any questions come in, I can jump in.
Yeah, perfect. Thank you, Simon. And yeah, again, welcome to everyone. Thanks for having me here, and I'm looking forward to this. So just to know, I can't see your questions. So yes, Simon, if you can, no problem to stop me as I go through. No problem. So really, in this webinar, I want to really bring something to the fore which might not be so obvious to a lot of people that are maybe new to trading or have been trading for a while. We're going to approach the topic of market function, which we believe is really another element that should be brought into your trading. And I'm going to cover that in full and really give you an understanding of what we term market function is and how it can play out in the market. So Mark, my trading partner, that's also a co-founder in Magnetic Trading, we've both been teaching and mentoring for over a decade, and through that period, we've definitely seen a number of reasons why people fail with trading, retail trading. So we'll have a look into some of those reasons and what the solutions are. Today, I'm going to give you a couple examples of market function which are coming up quite soon at the end of the month and the beginning of next month. And I'm also going to give you an opportunity for free to actually trade with myself and hopefully profit alongside some of our trades. So just a quick background of who we are. Mark and myself have over 30 years combined experience trading the markets. And as I said, we've been helping clients really just like you for over a decade learn how to trade and make success, or get some success in the market. Mark there, he is a FTSE specialist, a UK stock market specialist. I predominantly specialize in the German market, but also trade on the NASDAQ in the US. And you'll see today I do also trade occasionally on one of my favorite trades in Australia. So essentially, Mark and I are index trading specialists. It's quite funny, both Mark and I are from the UK. I'm from Scotland. Mark is from England, from London. But we have a company in Australia, oddly enough. So we do get down there quite a bit. And when I'm down there, normally I pop onto Sky News Money and talk about the markets and how we're getting on in the markets. So it'd be cool actually if there's anyone in from Australia as well today. That would be great. So why do we trade index markets? So index markets being markets like the FTSE, the DAX, the NASDAQ, the Dow Jones, the S&P, all index markets. We don't trade on FX. We don't trade on commodities. We don't trade on crypto. We have traded pretty much on all of these markets over the years, but we've really found that trading indexes are a lot more predictable and they perform certain functions over and over again, which we'll learn through the presentation is what market function is. So we can predict what's going to happen. We also trade at set times. Index markets, they open and close. So they open, for example, the FTSE opens at 8 in the morning, UK time, closes at 4:30. So you know exactly what time to trade. So generally, there's a lot of volatility at the open of the market. So we normally, not normally, we're there every day for about 30 minutes to watch what's going to happen. We've already set up what potentially we're going to do ahead of the open, and then see if that plays out. We're either into a trade and out of a trade within that sort of 30 to 60 minute period, or perhaps we're in a trade and we're risk-free and we'll let it go, or we might have some alerts. We're certainly not going to be sitting at the screens all day. Additionally, we don't really hold any positions overnight. So we're fully liquid. There's no pressure of having trades left in the market, or the concern of what's going on, having to always check price action, check prices, what's going on, and we don't trade any sort of news related items as well. So as I was saying earlier, with over a decade of teaching and mentoring, you certainly pick up some clues. I think we would be stupid not to over that period of why, clients, because, we all know the statistics that 90% of retail traders fail, or if you go to one of the broker, they might have a warning up there. I think it was one broker I was looking the other day said that 70% of retail traders on this platform are failing. So what are the main reasons they are failing? And we'll look at the solutions as well. Well, one is time, from all aspects, from the aspect of not having enough time to trade, so not being able to be there at the open or place trades, and too busy, you're in meetings, or you've got a busy family life or whatever, to having too much time trading the markets, or spending too much time in the markets, which certainly can lead to the third factor there, which is over trading. Additionally, leverage is key as well. A lot of people are trading on smaller sized accounts, really wanting to double and triple those accounts. So having high leverage, risking too much on trades, which certainly can have a leveraging effect of winning more, but it can equally have an effect of losing a lot more, and ultimately maybe losing your entire account. So time is important. Not trading too much. For us, the solutions with that is that we trade really at set times, and we know when all of our trades are setting up. Leverage we have at a set risk, and we have a full trade plan of knowing what trades we're going to be trading through the month. So traditionally, there's a couple of approaches to trading, either technical, which I'm sure you'll know about, or you're going to be hearing about today, or fundamental trading. We like to look at both of those. We take account of technical analysis and fundamentals. It's a big fundamental day today with FOMC happening, and what the US are going to come out with the rates. So certainly in my trade analysis today, I'm going to take that into account. I'm going to look at where the key levels in the market, but also I want to be looking at market function and what kind of trading days that we've got. So I'm going to give you a few examples of what we consider market function and how it works from both the perspective of buying and the perspective of selling. So there's certain things that keep performing over and over again in the markets. From a buying perspective, this could be the first trading day of the month, where we generally see funds being introduced to the market, and the market having an upward bias in the morning session. So we're going to ride on the back of that and take advantage of that using technicals and knowing that the market is potentially going to go up. Equally, on high dividend days, the market can often rally through the day, or it can rally towards the close of the day. In index markets, because they close, we create gaps. So it could be, for example, the DAX we're on Wednesday. So yesterday it gapped up. So it's moved higher than its previous day's close. So in certain situations, there can be market function opportunities for that gap to close. So we could sell towards that gap. And equally, in trending markets, say we were in an uptrend, there may be buying participation from the gap close, and also seasonal buying as well. Normally we see some season. I think everyone's fairly familiar with the Santa rally and how we have an effect in December that the markets can rally, and that's something that I like to take advantage of pretty much every year. So from a selling perspective, what are the days that we can look to sell? Perhaps the end of the month, where perhaps profits are going to be taken, or there's some window dressing from the fund managers of moving out poor performing stocks and, bolstering up their portfolio to make it look a little bit better with better performing stocks at the end of the month or at the end of the quarter. Equally, we have gap opportunities as well, where the market might gap up if we were going to sell, and we would sell back to the gap. And also we do have the opportunity of selling from the gap if perhaps we're in a downtrend. We're in a downtrend in the market. Often what you'll see is the market goes back up to the gap and the selling comes back in. And again, we have seasonality for selling as well. Often we'll see some kind of correction happen in the market around the September, October time. And we've certainly, if you just go back and look at the markets, normally you'll see some kind of correction come into that period, and then we start moving on up into sort of November and December. So we like to extract money from the markets using these factors that continually happen again and again and again, and some of them have extremely very, very high success rates and nice periods of volatility. So I spoke to Simon last week, and I was in Japan, and this is me skiing with my son there. He's certainly got a bit more hair than I have. I was 5 days skiing in Japan, and 2 of the days we had bluebird days where the skies were like this, absolutely beautiful weather, visibility was great, the snow was great, and we had 3 cloudy days. And I was kind of thinking about this with our trading, that I'll show you a little bit of an example of the cloudy days on the left there. That was the visibility. That's what we could see, and that was the result with my son, that he keeled over. So I thought about this with the markets, that with market function, we really know what the bluebird days are going to be in the market. When are those days there's going to be worse turning up? It's not fun skiing with no visibility. It's much better having a beautiful day where we've just got a t-shirt and a jacket on and the shades on and skiing down the hill. So with our trading, we know when those better performing days are going to happen, and we can plan our life around it, so we're not beholden to the screens, but we know, okay, I know at the end of the month exactly what I'm going to be doing. Not only do I know exactly what I'm going to be doing, I know exactly what time and how long I'm going to be at the screens. And I think that's a really key thing for people to get success out of the market is, let's face it, most of us are busy. So if you know when there's going to be a really, really great trade, you know exactly what time it is, you can start to plan your life around those trades, and you'll certainly have a lot better visibility. But it was an interesting one, just being in Japan, thinking if I knew when the great days were for skiing, I'd just ski those and I'd get on with something else on the other days. So look, we're on the 22nd of March. The last trading day of the quarter is coming up next week. The ASX end of quarter is probably one of my favorite trades. You can see on the screen here has an over 90% win rate. Mark and I, we've been trading it for a long time, but we've been trading it publicly, where we'll deliver exactly what we are trading ourselves out to our clients for over 5 years. And we have this wonderful win rate. And as I was saying before, this trade is really linked to perhaps profit taking coming into the market either through the day or perhaps towards the end of the day, where we see the market start to sell off, and we like to take advantage of that. Or, as I said before, it could be possible that poor performing stocks are getting sold off, and puts that selling pressure into the market. Another thing that we haven't really touched on as well here is that certainly, you know, through the last year or perhaps 18 months, we've all had this concern about recession. And you know, these trades, regardless of if the market's going up, regardless if the market's going down, they still work. These certain functions, regardless on conditions, still play out in the markets. Even if we've had you know, maybe a down month in the markets, we may still see selling come in. And we'll talk about the DAX in a minute as well. So I just wanted to give you a little bit of an example here of the trade that we just did on the 30th of December. Again, we know what time to turn up for this trade. So we know how long we're going to be sitting there. The blue line just really represents when we sold the trade. So we sold here on a break through these levels. We placed simply our stop above these levels here. And you can see the market just toppling off right into the close. So you can see that really stop to the distance we traveled is maybe 2.5 times. So a lot of these trades, not only are they high probability, they can have a multiplier effect. And by multiplier effect, I mean that if you risked 1, you could gain 2.5. So for an example, if you risked £100, you get £250 out of that. And then that's really important in trading. If you can have high probability trades and get a multiplying effect that you can make more than your potential loss. So we always have to factor in that loss. A 90% trade is going to lose at some point, and it's running at a very, very high percentage. So maybe over time that percentage may start to go down a bit. It'll still be very, very high. Most of our trades within our plan are sitting over 70% success rate. So let's roll forward to the DAX first of the month. Now, if you've seen me before, I've probably talked about this. I also taught some of you guys about this trade. It's something that I really, well, the ASX trade I'm very, very passionate about and believe everybody really should be trading it. And equally, the DAX first of the month is a great trade. It sets up on the first trading day of the month, every month. We trade it for 10 months of the year, and it literally takes 10 minutes to trade. I think everybody's heard about those 10-minute trading systems. I can tell you this one is absolutely true and genuine. And for the last 7 years, it's returned 12%. Just trading those 10 minutes a month for 10 months. So you get 2 months off actually in the summer. And that's risking 1%. Of course, if you risk more than 1%, as some of our clients do, if they've got smaller accounts, so you can risk up to 4%, depending perhaps on your account size. We tend to roll with, if you've got a 4-figure account, maybe you can risk up to 4%, or if you've got a 5-figure account, 2%, or 6 and beyond, 1% on the trade. And again, this trade is really recession proof. In the last 7 years, it hasn't had a losing year. Certainly last year, profits weren't as great as the market had a downturn. So we were below the average of 12%, but it still performed. It still had a great year in what essentially was a bear market last year. So again, this is pretty much tied to market function and fund managers. That if you think about it, that money is constantly being introduced into the market, really regardless of what's happening. If you think about all of the savers, if perhaps you're with the Pru or you're with Hargreaves, people's wages are getting deposited every month. That money needs to go somewhere. Either it's going to sit and wait for opportune moments in the market, or some of it's going to be deployed at the beginning of the month. And that's what we generally see, at the beginning of the month, in the morning session, that the market will most of the time move on up. So again, just another example here is March, just last month. We have a proprietary system. You just enter into the market right here. Our stop was actually pretty much here. We got a little bit close to our stop this time, but not triggered out. And again, you can see, I think this was a 2.5 time multiplier as well on this trade. And we simply just come out of the market. This is the open right here, and the market just rises up all day. We came out quite luckily this time, just on the pretty much the high of the day. We're not trying to pick the high of the day. This is just luck on that one. But we do know the best time to really come out of the market over the years, looking at the data, we generally see that just at the end of the morning is the time to just get out of the trade and then move on. So again, this is another trade. There's a set time to get in, there's a set time to get out, and you know those times you can get in, set an alarm when to get out, and you can just get on with your day. You know when it's going to happen. It's going to happen on the first trading day of the month. You can set that up for the next couple of years and put that into your diary. And certainly a lot of these trades are really, really great to perhaps tack on to your existing trade strategy, or if you're really, really time poor, it's a great way to not have the pressure of having to be at the screens every day and knowing when your trades are going to set up. So we'll have a look at the stats a little bit on this trade. This is just over up until February, actually. Doesn't include March, which was also a winning trade. So actually, it's interesting. It's not a massive success rate. It's got a just under 54% success rate. But the beauty about the trade is really that multiplier effect. That if we're risking one, that the average win here is 2.7. So getting a multiplier on the trade. This is another way that if you once the trade gets to 1-to-1, you can take half, and it certainly drops off the overall profit in time. But I thought I'd just give you some stats there as well. So maybe before we move on, Simon, any questions on that, or have you guys have got any questions on those particular trades?
There's no particular questions coming at the moment, Cameron. So
all right, I'll bash on. So this is really lifestyle trading in action. We have I've shown you 2 of these trades. We have 9 of these high probability trades. The reason I want to show you these 2 is because they're actually setting up fairly soon. Our clients trade these trades. We want to give you some examples of the profits that are being made. We not only trade real money ourselves, our clients are trading real money and making real profits in the market. Real traders making real money. So these are some of the results for the DAX first of the month. ASX is, they kind of go off the screen here. You'll note that some of the profits are a little bit different. That will be, as I said at the beginning, that everybody's trading a different account size, maybe risking a different amount on the trade. So sometimes people getting big multipliers if they were risking perhaps 4% on a trade, and we've got a 3-time multiplier, they could get up to 12, or I think there's one here where somebody got 15% on the trade. So normally we find the higher or larger the account, normally the percentage is less. But I also just wanted to add in my own trades just for this year. I took this snapshot this morning, and I do trade midterm, and I also long-term invest as well. But this is just my short-term trading account. So a nice return already for this year, and it's not even the end of the quarter. So there's another week or so to go, and there's certainly some good trades that are going to come in and bolster that profit that has already been made. So as I was saying, we've got 9 of these trades. They've got an over 70% win rate. 2 of these trades have over 85. You know, one of them's got 90%, which is the end of quarter for the ASX. We do also have a trade for the FTSE for the end of quarter and for the Dow. The next trade for the first of the month, of course, is going to be the beginning of September. Actually, I put the 1st of September. Maybe that's a little April Fool's. I think it's actually on the 3rd, if I'm not wrong. So please do note these, as these trades are going to be setting up. And also, I said that I was going to give you a little bit of a bonus and give you some free trades. So I'm going to do that. Previously, I actually taught some of you guys how to trade the first of the month trade. What I'm going to do now is I'm going to trade it with you. So I'm going to tell you exactly where to enter, what stop loss to have, and when to get out for April's trade. Plus, we're going to give you some ongoing education and market updates. So if you've enjoyed what you've seen today, and also want to trade with us on the DAX, or with myself on the DAX first of the month, I'll be happy to do that with you for April, and let's hope we have a nice winning trade. So Simon, if you don't mind just posting in the link that I gave you. So if you go to that link, you'll come to this page where you can put your details in. You can download our app, and via the app, I will send you prior to the trade what we're going to do, how to get in, and I will manage the trade for you. So if you're interested in that, please go ahead and do that now. I think, Simon, have you put the link in for the guys?
The link is there in the chat box. Lipani, I think you're coming down in April, which is great. Now, Tamin Biomi, I'm always struggling with your name. Apologies for that. I hope I did okay. Quick question says, in determining the high and low of the first of the month, what time frame do you recommend for marking the high and low?
You don't need any time frame, whatever. So yeah, it's something where we're not really looking for a high or a low. We're just looking to get into the market, set time, and get out. So sorry if that doesn't quite answer your question, but yeah, we're not going to look at that or look at any sort of time frame of the charts.
Okay. Graham's asking what percentage profit is that? I think that's referring to you showed the first quarter P&L for your own trading. What is that?
That will represent about 20%.
Okay, fantastic. Thank you. Anybody else with questions? No, I think we're all caught up. So the link's there in the chat box to download the app. So just to reiterate, if you download the app, that's where you'll get access to you trading the trade live.
Yeah, absolutely. I'll give you the entry ahead of time and manage the trade for you. So yeah, get on there and get that. Plus also, we're always putting some market information out, perhaps what's coming along. Get on there, we'll be talking about the end of quarter as well. That's coming up next week, and also giving you some advice about next trading.
Is there anybody here that's already a customer? Anybody that follows Cameron and Mark already? I know we've got one or two from Australia, Steve and Brisbane. I wondered if you've maybe come through the guys. Just interested to hear your experiences as well if you're here. Great, fantastic, Cameron. So these trades again, just to sort of, I know you mentioned this, but I mean the DAX trade comes up every month. What other regular trades come along? And
so we've normally got 2 or 3 really high probability trades that come along every month for market function. We're also there at the open if people want to be more active traders. We're at the open every day, and we do write reports every day, and we can have trades that come along. But really for people which are pretty busy, these trades are just the market function. 2-3 trades a month is perfect. And actually, funnily enough, these are our most profitable trades. So it's kind of like, it's the old thing, less is more.
So in terms of your own trading, you do sort of some sort of daily trades, but these are the big ones. Do you tend to portion more capital to these seasonality? I'm just trying to build a picture of how you manage your own trading. So
absolutely. So I mean, the thing is, I probably didn't mention that, is that because the market function trades have such a high success rate, we've been trading these for over a decade, so we're very, very confident about them. Part of trading is that you've got to have confidence and knowledge of your trades. So with those trades, yes, certainly we can risk more on that type of trade because we've got a lot more experience with it and we know how it really plays out. So for us, that would be, for Mark and myself, that's going to be sort of 1 to 2%. For the very, very high probability trades, we'll be risking up to about 2% on the trade.
Fantastic, thank you. Just see, Rohin says the link is not working, but I just checked it myself and it worked for me. Okay, so maybe try that again. Maurice is saying you can just go onto the App Store on your phone and search up magnetic trading. That'll take you to the same app there. So I did double check the link myself, so it is working okay. Maybe keep trying that. It'll take you to a page on the guy's website.
Yeah, it does. Or if not, just go to magnetictrading.com and you should be able to pick it up there.
Yeah, fantastic. Okay, terrific. Sven's link not working as well. I'll tell you what, guys. What I'll do is I'll put the link just to the website in there, so just to make sure you can get the right. And it's very clear that when you go onto the website, right across the top, it will say download the app. So that previous link is causing a problem. Just go there, that'll take you to the website, and you can navigate from there. Terrific. Okay, so exciting times. You've got these trades. Can I ask Cameron? There's a lot going on this week. With inflation's on the rise still in the UK, and we've got I think the Fed was at the Bank of England tomorrow, the Fed today. Any outlooks, any sort of hints of wisdom that you can drop? What are you expecting maybe to be happening? I asked the people on the webinar before we just started this morning. All this stuff with the banks, SVB Bank, FTX was it, and all this sort of, has that put people off trading or more or less? And most people have said actually we've stepped back a little bit. Volatility, even though it's sort of the urban myth, volatility is good for trading because you've got swings up and down. I guess you've got to know what you're doing, otherwise you tend to sort of take a little bit of fear and step back from the market. We still seem to be in the middle of a lot of stuff going on, the war. How would you be sort of playing things as we move forward? I know you can't predict the future. Nobody's got a crystal ball.
No, absolutely. No, definitely. I mean, we've certainly, I've taken a stance of just being a little bit safer in the market. It's there's a lot of undertones that are going on, so we want to be a little bit more careful, reduce a little bit of risk at the moment, only taking our really key trades, or perhaps for myself even very key levels in the market. We've been trading that and perhaps leaving some other stuff until until things settle a bit, because nobody knows what's going to happen. Everyone has a view. I have a view, but at the end of the day, we'll only know when the numbers come out, and we'll see what effect that has. And certainly something I was saying to my guys today is that, look, even if the numbers come out great and the market absolutely rallies, that's fine. We won't get FOMO about that. We'll still have an opportunity. The market will pull back, and we'll still normally get an opportunity to get in, which is exactly what happened the last time the Fed came out. It just roared. In fact, it was roaring right into the announcement. It went up higher, and the market came all the way back off, and we got a great buy and took it all the way up again. So I think it is, trading, as we all know, is about managing risk. And if there's uncertainty in the market, it's definitely time to take a step back, deleverage a little bit, and see things stabilize. Because but I think the banking it's not too bad in terms of now they've kind of come out and said they're going to backstop all the banks, and certainly the ones in US were a little bit smaller banks, maybe not Credit Suisse so much, but at the moment they're getting backstopped, meaning things are safe. But I think there's a lot going on at the moment.
There's definitely that's definitely the feeling there's sort of nervousness about. I mean, they backstopped the Credit Suisse, but that that wasn't enough, and then they got sold to UBS. But there's all the controversy over the AT1 bonds that were supposed to be paid out before the shareholders. I mean, it just seems somehow the rules the rules on the playing field are changing a little bit. So for the retail investor trader, it's think, well, if the guys in the city don't know exactly what's going on, and sometimes the Swiss can change the rules overnight, it does lead to a little bit of fear in the markets. And I feel that from people I'm talking to, just saying, oh, we just would like things to settle down a bit and be just, banks are supposed to be AAA rated corporate bonds, almost as good as a government gilt, but maybe not anymore. Times maybe are changing. So manage your risk, stop losses, tightening stop losses, or just maybe not putting as much out there on trades.
Yeah, I think at the moment, certainly for us, it's trade selection. So it's looking at our highest probability trades. What's the trade that you would 100% do? If that trade set up, I'm absolutely getting in, no matter kind of what the conditions are, because we've seen them so many times. Maybe reducing a little bit of risk. Stop losses, we normally look at our stop losses from a volatility perspective. So when we've got a lot more volatility, we've normally got wider stops. The risk in terms of is the same. So you'd be risking 1% on your account. So the risk is the same, but when markets are moving more on a day-to-day basis, our stops are normally a little bit bigger. But that's general. That's general through the year, regardless of what's happening. Volatility when there isn't undercurrents.
We question from Maurice: what is your criteria for entering closing the gap trades? Is that closing the gap trades?
Yeah, closing the gap. There's not to avoid the question, but it's a course in itself. But maybe just to give you a couple of sort of rough examples, perhaps when there may be more high probability gaps is really when we see perhaps the market gapping up a couple of times. Maybe we gap up a couple of times, and then on the third day it's a little bit more probable to go back to the gap or gap down a couple of times. But it's a more than an hour in itself.
Yeah, well, you don't want to give just a little bit of information, might be dangerous. So
yeah. But come along, Morris, join the app, and I know that Mark is very much involved with gaps, and we do give information out about that. So yeah.
Well, Mark is speaking tomorrow at this
on gap. Yeah.
So he'll be he does a talk on the FTSE gap.
Yes.
So tomorrow at 10 a.m. UK time. Again, your partner Mark will be talking about that. Fantastic. Just got a couple of minutes left, really, before we'll go to change over to our next speaker, Chris Tubby. Anything else you can leave us with, Cameron, in terms of some markets that you would be looking at, or anything that we would like to ask in these last couple of minutes while we have Cameron here?
Let's see if the guys ask a question.
Yeah.
For me, I'm waiting for the good trades that are coming up next week. And yeah, we'll also just be keeping an eye on some key levels, get this news out of the way, and yeah, see where we're at.
Fantastic. Thanks to Steve. Thanks for coming. Okay, well, if there's no more questions there, I think we're okay. Tina says too many people downloading the app. Well, could be. It could be something. Hopefully, did you get the link to Worksfend and Roheen? Hopefully, you managed to get it working okay by now. If not, come back to me later, and we can certainly sort that out. Cameron, thank you very much indeed for
Thanks so
that.
much. Cheers and thank you, everyone. And yeah, we look forward to seeing you in April, right?
Seeing you at the end of next month in London
Yes.
in person, which will be great. Yeah, Cameron and Mark will both be attending the IX Trader Show in Covent Garden next month that I'm hosting. You can actually get yourself a ticket just at the bottom here. You click on that green button, that'll take you to the website, and you can book a ticket for that. It's a full day event. We've got dozens of expert speakers delivering content and seminars, all sorts of things going on. In fact, Chris Tubby, who's just waiting in the wings at the moment, will be there as well. Andrew Lockwood from City Traders, we're hoping they'll be there as well. So it should be a great day. So thank you, Cameron. I'll take back the reins so that we can cross over. I'll let you enjoy your evening, and we've got a full day in front of us. So Cameron Malik from Magnetic Traders, thanks so much for joining us.
Thank you.
So if you can just unshare, I think that's it. Yeah, thank you. Okay, fantastic. Great to see so many of you here, which is really good and interesting to hear where you're all from. We've got people from Australia, Detroit, Scotland as well. So all sorts of people from all over the place. Graham's in the west of Ireland. A really international event. We love it. We love it. We're all here for trading. We're all here to learn just even one or two new things. If that's all you pick up during this event, what I hope we don't confuse you, because we're throwing all sorts of different strategies and all sorts of different ideas for long-term trading and short-term trading. But it's all, if you could just pick up a few things that help you, then yeah, we've done the job, which is great. Our next speaker, Chris Tubby from Simax Fintech. Trading education doesn't really do justice. Chris has over 50 years experience in the markets, mentors some of the best city traders in London, as well as retail traders, and has a mass of knowledge. Follow him on LinkedIn, and you'll see the daily posts. I'll put the link in there to Chrissy's link to fantastic content that comes out on the current markets, looking ahead to these trading events. And we're pleased that he's joining us for this webinar. He's going to be with us as well, as I said, at the end of April at the in-person show. But today he's here to talk about one of the most important things, which is having capital to trade with, having a funded account, and how you can go about accessing and being able to prepare to pass a test, which a lot of companies are offering now, whereby you can purchase a test, and they will help you to get to a level of competence in trading where they will entrust you to trade with some money that they will loan to you. I mean, the takeaway is clear. The larger the pot of money that you trade with, the larger the return. If you're 10% of £10,000 is bigger than 10% of £10,000. But it's not as easy as it sounds. But so Chris is here to tell us how to go about assessing these trading challenges and how you can go about managing the risk, but while keeping the profits going. So I'll just invite onto the screen. This normally just takes a few seconds. And the less risk you have to take. Andrew, yeah, good point. Andrew Lockwood is here from the CZ Traders. Again, Andrew, I know you offer these services as well. So we're looking forward to your talk at the end of today's agenda, which will be fantastic. Chris, I can see you were accepting connecting, which is great. So all systems should be go. If anything goes wrong in these live webinars, this is the time it does, folks. Was we're changing from one speed to the next, and sometimes we do have the odd hiccup. But I think we're all good today. Okay, we'll just be patient. We have tested this out, Chris and myself, so we're hoping it should go as it did in the test. Okay, not going through yet. Chris, I'm not sure if you can hear me. Okay. Okay, I'm just communicating with Chris on WhatsApp to see what's happening at his end. No camera or audio. We had this issue before. Okay. Okay, folks, apologies for this. Chris has an issue with his laptop. He doesn't have the camera or the audio connecting, which is unfortunate because we did test and we had it working okay in the test. We're trying to think of a workaround, which is where I will run the slides, and then we'll try and bring him in on a phone call. So time for maybe a quick cup of tea or coffee if you want to take take a few minutes. I think this will take us a few minutes to resolve, but we do have a plan. But now's the time to go and pop the kettle on. I'll have a quick walk around the house, whatever you can do, and we'll maybe regroup in 5 minutes. We're a little bit ahead of schedule, so it's only on the hour now, so we shouldn't lose up too much time. Okay, so let's see. Okay, so let's try. Okay, right. I'm not sure if this is going to work, but let's give it a shot. Okay, so everybody should be able to hear and see that screen. Is that everybody sees my Chris? It's Simon. All right, listen up. What I'm going to do is put you onto the microphone, and hopefully you can just talk through this way. And I know I don't understand. Let's see if this works. I'll just put my phone next to the speaker and see how that works. Okay, can you hear me?
I'm just testing. Can you hear me?
I can hear you, yes. There might be a little bit of feedback. Okay.
Is there any feedback now?
No, that sounds better.
Okay, because I've just turned off the stuff on the
Okay.
computer,
So on the screen, what do you see, Chris? Do you see your slide?
No, I see you as a silhouette with a picture of you in front.
Okay. So something's happening with this, with my computer now. Oh dear. Oh dear. Right.
If not, if you just show the slide and you start from slide 1, I'll tell you when to switch over, and I can see them from my side as well.
Yeah. I'm just. I'm having a.
Tech issues as well.
Yeah. Just I'm sharing my screen, but it seems to have. No, it's frozen. It's frozen. Okay, I'm just gonna have to log back in as well. Right, we'll log back in. Take me just 1 or 2 minutes.
You're back now. I
Okay,
can see you.
so can you see?
If you share your screen with the PowerPoint, then I will add my one in front of me, and then I can just say change, and then you can just kindly just move the slides for me.
Yeah, I'm just trying to get off the. I can see your slide, but I can't actually see anything else. So
Tech's always great when it works.
it's just we even did the test. So it's why is this not? All right, just stay on the line, and I'll reboot back in. Okay, so hopefully you'll be able to see and hear me again.
Okay.
That's great. Let's just put this. Okay. So can everybody hear myself, and can you hear Chris as well? People, just Chris.
Hi, everybody.
Just let us know if you can hear, and yes, okay, it's great. Okay, we're gonna get through this. So you should be able to see the Cymax FinTech screen, and you can hear Chris. So Chris, if you just want to start, we're talking about trading challenges. We're getting back on track. So
Okay. So can you hear me okay?
yeah.
Okay, shall I dive straight into it, Simon?
Yes, please, Chris. Sorry, we've just wasted. We've lost a few minutes, so let's try and catch up. Trading challenges.
So I'll do my own introduction, so don't worry.
Thank you.
Okay, so hi everybody, and welcome to where I'm going to talk about trading challenges today, and just having a bit of a different topic rather than just actual trading, you know. So if we can switch to the second slide, please. Okay, so very briefly, and I'm going to rush through this now. So we are a leading EdTech company. We offer a variety of online workshops, courses, and we do also an accredited masterclass. You know, what we're trying to do is help people to become traders and give them a career in the markets. And by doing that, obviously, we have to provide the best education and experience to do that. So there's contact details for us there. Also, next Wednesday, we're going to offer a free 2-hour introduction to trading. It's not just for beginners, so even if you've got some experience, it'd be worth coming along to that. That will start at 1 o'clock in the afternoon UK time. But if you contact us at info@cymaxfintech.com, we will send you all the details around that anyway. Just very briefly about me. So, yeah, as Simon said, I've been in the industry for 50 years. I was senior trader at 22. My current role is I'm Senior Director of Trading and Education at Simon Fintech. And of course, you know, it sounds like fintech, so crypto, but we trade all the asset classes, and I've done that going all the way back through my career. And more importantly, I've been a prop trader across all the asset classes for the last 37 years. I also consulted to the London Stock Exchange. I believe Simon's put this already, but there's my LinkedIn profile, so you can actually see my experience. And of course, you know, if you're going to go to an educator, make sure you do a background check on them to make sure that they are who they say they are, and they've got the experience to train you for sure. Okay, Simon, can we move on, please? So, just a brief, on Friday, I'm presenting another webinar, which is Macro Outlook, and that's sponsored by Tickmill. There's a link for that. We provide weekly YouTubes just to help you prepare for the week ahead. So if you're already into trading, it's a great way to sort of start your week. I look back at last week, I look forward to this week, I give you the macro outlook, your trading tip, and I also do some chart analysis for you in that, and we either put that out very late on a Sunday evening or very early on a Monday morning. We also provide a daily newsletter with global news, plus, you know, fresh daily chart levels, and that includes pivot points, which we believe work very well. What I'm talking about today is a funded trading account, and you know, some of the skills you're going to need to pass and qualify to get that funded account as well. And there's the details there of one of the companies that we believe are excellent at this, which is the Nordic Funder. And again, contact details below, and there's my email address as well, just in case you want to aim anything directly at me. I'm always happy to hear from traders and answer questions wherever possible. So next slide, please.
Okay, we should be looking at the funded trading account slide now, the benefits.
Yeah, Okay, so when we look at a funded trading account, what is that and why have we got that? So the great thing about a funded trading account is you're not using your own capital. And of course, many traders, they sort of fail in trading, and that is because they are undercapitalised. They haven't got enough money, especially if you're new to trading, because you go through this sort of J-curve where you're likely to lose money before you get trading, and then you start to take your capital and your account back up again. Now, there's a lot of trading challenges available from different companies, but just, sort of look at the small print, look at what you're going to get and what it entails, because, many challenges have a time limit. And that puts you under too much pressure. 30 days to sort of accumulate or create, say, 10% revenue. You wouldn't do that to yourself. So why take on the challenge that does that? And also, sort of many of these challenges, they will charge what they call a reload fee. So if you fail, then you've got to pay again and again and again to keep trying to chase your dream of getting that funded account. And also, many challenges limit your trading day. They don't allow you to carry overnight positions. Some you have to get out early in the day. Some, the majority you can't carry over weekends and such like. If you look at the Nordic Funder, it's sort of removed a lot of those areas that sort of challenge you more. The challenge of passing it is enough on its own, but they want to help you to pass by making the parameters around that as good as they possibly can. Obviously, you still need those skills to qualify that, and to cover that, you've got to understand risk management. You've got to know sort of how to manage that risk. You've got to, not necessarily, but you should understand technical analysis to a degree, and the importance of those accurate chart levels. If you draw a line on a chart and it's just slightly too low or too high, that can be the difference between you getting stopped out in the market or not, because you get in a little bit too early into that trade, or you're perhaps trying to get a level that it's not going to quite reach. And of course, there's a variety of trading techniques to learn as well. Now, trading psychology is a massive part of trading. If you're new to trading, you'll soon find out a lot about yourself as well as about trading in general. Now, I would say, a great book to do to understand the psychological aspect is called Trading in the Zone, and I recommend that to all the people that come through my courses. And to be honest, I've never found anyone that hasn't taken something from it. You also need to develop a trading plan. These are just sets of rules, and I'm going to cover that as we go through this. Also, I'm going to cover mistakes that new traders make. And also, you've got to be aware of trading data. If you're not experienced enough, then that can be problematic for you. So I'm going to move on to the next slide now, which sort of explains sort of what Nordic Funder offer you, and this is a great opportunity for you if you are undercapitalised or you want to get into trading, you don't think you've got enough capital, then this is a great way to get into trading. So they've got, first of all, they've got 54 currency pairs. You can trade crypto, metals, indices. So there's lots of different asset classes that you can get involved in. But of course, here the important thing is understand what you're trading. Know what impacts that market. Because otherwise, quite honestly, all you're going to do is throw your money away. And that's not the idea of this. The idea of this is that you pass and qualify for a funded account. And to that degree, we actually provide a preparation course to help people to pass. No, all we can do is guide you and explain it to you and show you some, give you some trading skills to help you to pass. But that doesn't guarantee you're going to pass, of course. Now, again, account size, you can select anything from $25,000 all the way up to $1 million. And great profit splits as well, anything from 50% to 90%. Now, they also provide the option for you to be able to have automatic stops and weekend trading, which is great, because quite often you get out of those trades too early because you're restricted by those time constraints. Another area is pretty much the same as most, not all, but most, is a target of 10% profit target. Now, the important things here is, of course, you want to make that profit, but you've also got to understand how much you are allowed to lose. And the maximum is a 5% trailing drawdown on that account, and a maximum 4% daily loss. Now, here's the great thing, there's no time limit, so you're not under that pressure, those time constraints, to achieve this 10% in a matter of days or weeks. You've got time on your side to qualify. And also they will offer you leverage of 10 to 1 or 20 to 1. And there's a link below that where you can sign up for the Nordic Funder, or at least you can go onto their website and see more details about it. And of course, they'll always answer any questions you may have on the challenge itself.
Chris, this is just because I can't see the questions at the moment myself, so apologies if anybody's asking questions while I'm sharing the screen. We will answer.
Just do that at the end as a quick
we will answer the questions at the end. I kind of feel I've got ESP for these things. I've done so many. I kind of feel that probably might be 1 or 2 questions come in. So we haven't forgotten. It's just that I'm blind at the moment until we finish the slide, and then we'll get into the questions.
Yeah, sincere apologies about this, guys. I mean, it was all working so well, and we even had 2 laptops set up.
The best laid plans of mice and men.
Yeah.
Okay.
So, fortunately, it doesn't happen when I'm trading. So, I just want to talk about a few things around trading now, because, the challenge is great, but, you've got to have the skill set to be able to pass that challenge. If to become a trader, you've still got to have these skill sets and understanding of the markets. So, I would say it's important to be selective when you're trading, and only trade when the market meets your criteria, your conditions. Don't go jumping into trade, because they're low probability trades, and they're just not going to work for you. Trading is really about quality rather than quantity. You can trade 100 times a day, but it doesn't guarantee you're going to get any winners. Sometimes it's better, my best traders, they only trade between 1 and 3 times a day, because that's all they need to do. And of course, when the markets are really volatile, or you're not understanding the markets, then sometimes the best trade is no trade. Wait until the market calms down. Wait until the market's right for you. And of course, timing is extremely important in trading. When you're going to enter those trades and where to exit those trades as well. Getting too early, too late, you tend to get stopped out. So, trying to get that perfect level is also very difficult. So, that's where your trading techniques come in. Personally, I build positions. I deal in zones. So, I find a buy zone or a sell zone, and I build my position within that area. And I do the same when I'm taking profits as well. And of course, especially in today's markets, but in general, most trades will actually go against you before they turn in your favour, if they're going to turn in your favour. And again, that's where you've got to be disciplined. You must know when to get out of a bad trade. And of course, during the day, you've got to be aware of market moving events. That could be news such as data, central bank speakers, even politicians. Tonight we've got obviously the FOMC. Tomorrow we've got the Bank of England. And when we look at the FOMC tonight, go back 2-3 weeks, everyone was pretty much sure it was going to be a 50 basis point hike And then, of course, the banking chaos over the last couple of weeks has changed all that. So now we've got a mix between nothing changing or perhaps 0.25%. Now, something I would just say to you here, if you're going to watch that tonight and you're looking at that, dot plot is really important because this is the future projections, and you could see that that's adjusted from the last meeting where we had the dot plot. We only get them one every quarter, so the last one was in December. Okay, so I'm now moving on to the next slide, which is risk management. So managing losses, that's only half the story, really. It's a very important one because we have to control those losses. We don't want to blow our account with one trade. You don't want to blow the challenge with one trade, most definitely. But the other part of the story is knowing when to take your profits. You've got to have those good trades to cover any bad ones. And what you want to be doing is getting that risk-reward ratio where 2 or 3 of your good days should cover 5 days if you have that many bad days. But it's getting that balance right. So, most people will talk about stop losses quite rightly because they're so important. But also, knowing when to take that profit is very hard to do. And again, that's why I deal in zones. As the market's going in my favour, I feed into that, taking percentages of my profit of 5-10% at a time, just feeding in. If I'm long, when it gets into my profit zone, I take off 5 to 10%, then I'll take off another 5 to 10% as it keeps going in my favour. If the market turns and it starts to come off, I'm not going to panic and get out of the risk. To be honest, if I still believe where I bought was a strong level, and if the market gets back down there as a retest, as the market loves to do, it goes up and then it comes back to a level just to test if the buyers are still really there, if their resolve is still there. And then I will buy back any short, and then go longer again, reinstating my initial position, and then looking for the market to rally. Of course, I've still got my stop loss there, but if I've sold 30 to 50% of my position and I do end up getting stopped out, it still hasn't cost me any money.
Chris, what about adding to trades?
Yeah, I do that sometimes. So, quite often I'll break my orders into 3 pieces. So, I'll split it into 3. So, I've got my optimum level, which is going to be very close to a support or resistance level. But then I work out my entry level. If you wait for the perfect level, if you're a hedge fund, it's great. You don't need to trade that often. But, if you're trying to get a trade on, say, even every day, then sometimes you just have to give the slight edge away to get some of that position on. Because everybody wants to buy at the perfect level of that support line if they're seeing the same tech as you. And of course, if you wait for that level, it may not get there. It may get rejected early. So I tend to just come inside that with part of my order, and then I work out where my optimum level is that I would love to get filled at. And then I'll have a mid price as well. So I just break my order into 3, basically. If I'm currently active and watching the market, then I'll just feed into it manually as I'm going along. But all I'm trying to do is get a great average. But what I don't want to do is miss the market. Now, I might get my first set and I might get my second set, but the market rejects and I might not get the third set. So then I have to make a decision as the market starts to move higher. Do I wait and hope it comes back down? But chances are it's probably not going to now. But I want to get my full size on. So then I will come in and buy the last part of my position at a higher price. Now, I'm paying a higher price. I don't mind doing that because the market's already moving in my direction now. The market's already got that momentum building. The buyers have come back into the market. I'm long 2/3 of my position. I'll come in and buy the other third, not far away from where I went with my first entry level, to get my 100% of my position on. Because I like to keep my volume constant. I don't want to be right in a 1 or in 100, so I always want to have the same amount on where position on and it has a big rally, I'm not going to chase it just to get that last part because it would have gone too far. But every trader is different, and you will find if you're new to trading that there's so many different trading styles out there as well. Okay, so now moving on to the next slide, which just sort of highlights risk reward to you. So, if you're willing to accept a one-to-one risk reward, so, okay, if I'm prepared to lose, say, $100, I'm happy to make $100. Now, it's okay, sometimes you may have to accept that, but it makes it much more challenging for you because just being right even 50% of those trades is not enough because you're not going to make any money. Whereas if you're working on at least a 2-to-1 risk-reward ratio, which personally is mine, I'm not going to go into a trade unless I can see a minimum of 2-to-1. So however much I'm prepared to lose in that trade, I have to see the potential to make at least twice that. And trust me, when I'm looking at taking a position on, the first thing I gauge is the potential loss, how much I can lose, before I work out how much I can win. And that's really important. Everyone dreams of having these big wins, which is great, but, it's controlling those losses, managing the losses, and, working out whether the position you're going to put on is affordable. Now, I've got something I call the 3 V's, which is volume versus volatility. So, it sort of got brought up in the last speaker. So, what I'm looking at here is as the market becomes more volatile, I reduce the size of the position I'm going to enter with. And then that allows me to have a wider stop, but without increasing the potential size of the loss. So all I'm doing is I'm sacrificing a little bit of my size. I'm going in with a smaller size so I can have a wider stop, which, it's not to avoid getting stopped out, because if I'm wrong with my decision and the market's going to go against me, then I need to have that stop loss there to protect the rest of my capital that I'm going to use for future trades. So if I go in with that, and I've got a wider stop, but again, be careful, because if you've got a wider stop, you've got to make sure that the market can give you that double reward still. So if I'm prepared to lose, say, 20 points on a trade, can I make 40? If suddenly I'm going to look to sort of stop myself out of a 40-point loss, then can I make 80? Can the market give me 80? And again, that's another really important point, because you can't ask for too much from these markets. Probably at the moment at times you can get away with it, but you've got to have that risk reward there. And for me, as I say, my minimum is 2-to-1. But at 2-to-1, if I get 5 winners and 5 losses, I still make money. I'm still up $500. If I'm working on a $100 win. If I've got 6-4 on my winners to losers or 7-3 on my winners to losers, then okay, I can scrape a profit with 1-to-1, but that to be honest, that doesn't interest me. I want a minimum of 2-to-1. And sometimes I'll get 5, 10, 20, or even more than that, because then I'll start to run those profits, especially the last part of any position that I'm exiting. Now, again, when you're thinking about this, can you get 50% of your trades right? Can you get 60% of your trades right? 70%? Sometimes that can be very challenging. But, if you're working on a risk reward of 2-to-1, and even if you only got 4 of them right, you're not going to come out with it very much, but at least you're not losing money. So that, that risk reward is really important, but also along with that is the amount of winners to losers that you have.
Chris, is there a limit to the amount of trades you can have on at the same time while you're doing one of these challenges?
It would all be within your capital. So how much capital you've got will define on sort of how many, what size open position you can have. Because you can go from 25 up to 1 million. So it depends what level you take on, and the margin requirements to sort of the size of position that you'll be allowed. And then, of course, as your account either increases or decreases, that would potentially adjust that as well.
Sure. Because what would you recommend for someone that's, just started out? You haven't traded before. Is this something that you should, consider, or maybe you should have some trading experience before you go down?
I would say before you try the challenge is practice. Go on a demo account. Practice your trading. Do a course. That's why we're here, is to help people to get into trading, and then to help them stay in trading for the longevity. But it's just diving straight in blindly to do a trading challenge is probably not going to work for you, because you don't understand trading if you're a beginner.
Because let's face it, if you learn the skills to pass the challenge, you're learning the skills that you can just keep using these things. It's not just a challenge.
Totally. You build on them as you go along. But without those foundations, it's very difficult to become a trader, full stop, whether it's through a challenge or whether you're doing it with your own capital.
Yeah. See, I think the thing that I think is good about these challenges, and one is the access to capital, because I've been doing these webinars for years. I've met a lot of traders, and one of the biggest problems is starting with too little money. They do 3 or 4 trades which don't return a profit, and they're gone. The account's blown, as they say in the trade. They don't have any capital left. So having capital to trade with is a good thing. It can allow you to take a different approach to trading, which is much better suited for you. The other good thing, I think, is that it trains people to think from the outset about losing and managing that risk. Because just to reiterate what you've been talking about, if you continue to manage the risk, the portfolio, the trades should look after themselves. But that's the opposite of what most people do when they come into trading. Most people, as I say, they've seen the people on the internet, the Ferraris, and they look for the big trades, they look for the big wins, and particularly men, where we all want to have that big ego trip. But that's very much becoming it's not the right course. These programs are teaching you to go into tiptoe into trading, looking at keeping the downside risk minimized at all times, which I think is a very good piece of advice to live by.
Yeah, you want to create consistency. That's the key to trading, having that consistency. And also, if you can take a little out of the market every day, then that accumulates. And also, I've always been a steady Eddie. I can make money most days. I don't make money every day, but I've got quite a good track record there. But it's about, I've got friends that would make a ridiculous amount of money in a day, but then they would lose a ridiculous amount of money another day. So they would go through that massive emotional roller coaster in trading. Whereas for me, if I had a bad day, I'm controlling that anyway. But for me, it's just okay. Well, that's my day. That's my loss out of the way. I'll come back tomorrow and start again. It never bothers me. It's just the cost of trading. If you can't accept losses, then trading's not for you. You have to be able to accept losses. It's not personal. It's not the market getting personal with you. It doesn't know you. But you have to be able to just move on from it. I'll come up with the slides, but, going into revenge trading and such like is dangerous as well. But I'm going to cover them in a minute. So, okay, now we're going to move on to a little bit about technical analysis for anyone that's new to trading. Move 2 slides. So the first one's going to be a candlestick then. So candlesticks are used by the majority of traders. It gives you some really good information. It's showing you the lowest price and the highest price is traded within that time frame. That time frame could be anything from 1 minute up to 1 year, or even longer. And again, that's dependent on how you're trading. But the other information it gives, if you've got a green candle, it means that it closed higher than when it opened within that time frame. you're looking at the size of those candles because it gives you an indication of how volatile the market is, on whatever time frame you have it. Now, a lot of pro traders, they'll use dailies, they'll use 240 hours, 30 minutes. Training wise, I don't advise people to really go below 30 minutes. I mean, you can look at charts below 30 minutes, but I wouldn't use them for your decision making. You're going to get a lot of false signals from that.
False signals.
And because there's certain types of charts, such as candlesticks, that the pro traders are using half hours, and market profile and some others, the half hour, so on the hour and the half hour is extremely important in trading. Sorry, Simon, did you want to say something?
No, I was just wanted to ask why you don't recommend going any shorter than 15 or 30 minutes as a time frame.
You can get lots of false signals. If we're looking at a triple bottom, so the same price that's been hit 3 times, if you're on a 30-minute, that means that price has held for over 2 hours.
Yeah.
If you're on a 5-minute chart, it means that it's been there for 15, 20 minutes, which is nothing. And that could even just be one order that's holding that market there.
Fantastic. Yeah, thanks.
So the longer the time frame, the more solid that signal's going to be, when you're sort of identifying those opportunities.
What about the stress factor as well? I mean, trading every 5 minutes can be.
It's too much. And sometimes the best thing to do is put your position on, put your stop loss in, put your take profit in, and walk away. Otherwise, you sit in front of that screen, it mentally drains you, number one. But number two, you get so tempted when you're in profit to take that profit too early.
Yes.
Oh, look, I'm making money, cha-ching. You take it, and then next time you look, you could have had 2, 3, 4 times as much.
Yeah.
Sometimes, as long as you've got your stop loss in to protect you, and hopefully a take profit as well, then you don't need to be in front of that screen all the time. And it does take away that temptation. Okay, so I've moved on to the next slide now, which is candlesticks. So as I just sort of mentioning, they are favoured by the majority of traders. There's many different patterns that can be identified. The doji, which is just a cross where the market's opened and closed within that time frame at the same price, is just indecision, so that's quite useful for us. And if you get the same price, keep getting hit and rejected, then it forms these double or triple tops or bottoms, and they can be very useful as well. Now, moving on to the next slide. So the top one here is the candlestick, and the one below is sort of like an alternative type of candlestick, which is called the Heikin-Ashi. Now, I like to use both of these together, and the reason for that is I use the candlestick for drawing on my support and resistance lines, and basically for my technical analysis. But I use the Heikin-Ashi for sentiment, because as you can see, even though it's the same data, it looks very different. And so you've got much more of a flow, much more consistency in the colouring of the candles. Now, the reason for that with the Heikin-Ashi is its start point. So basically, each new candle starts at the midpoint between the open and close of the previous candle. And it's why you will never get a gap in a chart. If you look at the candlestick above in the middle there, between September and October, there's actually a gap. But there's not one on the Heikin-Ashi, and you'll never see that. But you should never do sort of like your support and resistance analysis from a Heikin-Ashi, because if it's got a flat base or a flat top to it, that may not be a real price that's traded in that time frame. So you just got to be a little bit cautious with doing that. Stick to the normal candlestick or bar chart or the light chart, whatever you're using for your traditional analysis. But as I say, I like Heikin-Ashi because it does show the trend, and it shows when the trend is changing as well. Okay, so just moving on, so just emphasising some of that. So it's very much like a candlestick, very visual, but all I'm looking for it is because that could lead to a reversal. So moving on again, I'm just going to show you a couple of different chart types. I'm just mindful of the time, so I'm trying to sort of get through this. May not have time, miss out at the beginning, but this is a point and figure chart. Now this doesn't have any time element. The time down the bottom there is just for reference. It's only price action. So it's a useful one, but you can see support and resistance in the market. Obviously I do provide all the courses for all of this, so if you want any deeper content on all of this, then reach out. Because I'm going to have to cut this a little bit short, just reach out if you've got any questions and I'll answer them anyway for you. Some of the studies we use are pivot points, so we calculate them off of yesterday's data, so high, low, open, close, sometimes we only use high, low, close. And it's based on Fibonacci, and it produces these pivot points, which is just support and resistance in the market. And the same with any line. When the market's below it, it's a resistance point. When the market's above it, it becomes a support point. But it's very useful, and they do work very well. They're not, it's nothing in trading is 100%. But they are very useful. They do give you insight of where to see support and resistance in the market. Moving on to Fibonacci. Now, Fibonacci is more for when the market's had a big move, and we're looking for when the market is turning. And, in the first instances of the market turning, our expectations are that price is probably then going to turn and continue in the direction it was already going to continue that trend. So that means that we're just having a minor retracement. And then we can use Fibonacci to help us to identify where we could see some support feeding into the market. The red one, the 618 level on that, is also called the golden ratio, and that's where the majority of technical traders will be very interested in should it get there. Now, if it breaks the golden ratio, and it closes below there, then it looks as though it's gone from being a retracement to then being a reversal. And I'm quite happy to trade them as well, because then my expectation is if it's convincingly broken the golden ratio, we could see it all go all the way back down to that blue line at the bottom there, where the move initially started from. So moving on again, so trend lines, very simple. You try and find three lines that touch, three bottoms of bars or candles, whatever you're using the wicks, and you draw those trend lines on, or support resistance lines on. You can trade inside them, or you may be a breakout trader. You might like to wait until that line is broken and then get into a position because you're following the momentum of the market. So, when you're new to trading, what type of trader are you going to become? Are you going to be a bull or a hawk that loves to buy the market first, a bear or a dove that likes to sell the market first? Most like to be a bull or a hawk because they want to get long of the market because they don't like to sell something they don't own. But there's a great saying that bulls make money, bears make money, but pigs get slaughtered. And what that means is that if you're pig-headed and you hold on to your losses too long, then, the losses are going to just get magnified out and you're going to have a very short trading career. Now, also, a lot of it comes down to your character in trading. Everybody goes through a unique journey. So, is your character more aligned to slow conditions or fast conditions? Passive, aggressive? And are you patient or impatient? All of that is going to help define you as a trader going forward. Sorry, that was on the one type of trader am I slide. So you may have been looking at the wrong one there.
Over there.
Okay, influences. So the next slide. So with influences, if you're unwell, don't trade. As simple as that. Think, I can do this, but you've do those trades. So if you're not feeling well, don't trade. Take a day or two off, come back refreshed, get back into the market again. And sometimes that can work even better for you. You know, when you're in front of your screen and you're focusing on your trading, try and forget your personal life. You know, don't let that keep coming back in. It's a distraction. Now, always, you know, once you've created your trading plan, always follow it and remember to follow it. These sets of rules. Avoid distractions and beware of other traders' views on social media. You know, there are some great traders out there, but just be wary of who you're following. And remember, even the great traders get it wrong from time to time, even Warren Buffett.
Yeah.
So, you know, don't just sort of follow them blindly. You know, if you've got a different view, then don't trade. Or follow your own convictions, because that might be one of the times you're right and they're wrong.
Just beware of social media, full stop, I think.
Yeah, just be wary of it. And, you know, always look at someone's background. You know, do they have the ability to actually, you know, it might sound great, but it doesn't mean that they are great.
Yeah.
So moving on to the trading plan. So with a trading plan, I like this, Sun Tzu. So most pro traders have read Sun Tzu. So he was a famous Chinese general and philosopher, amazing. Some of the things, but he's got some great quotes. And the one I like is, in war, the victorious strategist only seeks battle after the victory has been won. Whereas he is destined to defeat, first fights and afterwards looks for victory. So in modern day trading terminology, plan your trade and trade your plan. And one of Warren Buffett's famous sayings, ones that he likes the most, I would say, is, in the midst of chaos, there is also opportunity. And he tends to be all over that when it happens. Okay, so very quickly, are we okay just for another 2 or 3 minutes?
We've got about another 5 minutes, yeah.
Okay, cool. I'll sort of try and just push through this. So,
no problem.
Trading plan. Now, trading plan is so essential to your trading. It's what's going to help you with your consistency. So, in my, you know, in life we like to break rules, but with a trading plan, keep you safe, so don't break your rules. Now, for me, it's in 2 parts. The first is the financial setup. You're only going to trade with money you can afford to lose, and if you can't, then go and try one of these funded trading challenges, so that you can pass it, and then you've got that funding. Decide on your career stop loss. That means, you know, if you're going to use your own capital, don't risk all of your capital. Decide how much you're going to risk. Same as if you're going to invest in a share or you're going to invest in a business. And for me, one of mine is, if I have 3 consecutive losing trades, I stop for at least an hour to work out what's going wrong. If I can't work it out, I don't trade anymore. And if I do, I'm probably going to have a small trade. But, you know, what I'm not going to do is keep doing more and more losses and just damaging my capital more and more. So, you know, maybe you can work out your own one. But for me, because I don't usually have 3 consecutive losing trades, that's the number that I've selected. You've got to have risk management. You've got to use risk reward. A happy level. So what I mean by that is, you know, if you work out all of your living costs, which have gone up through inflation these days, so you work out all your living costs, you work out all your business costs, which could be your trading costs, and then you add a percentage onto that. And then you divide that down from a month to a day. Then if you could make that every day, then you would be happy. I hate the word target, because it can make you risk too much to reach that target. Yeah. Or when you reach that target, you take your foot off the accelerator when really you should have gone more. The second part is just the trading setup. You know, mentally prepare yourself for the day. Am I ready? Because if you're not, then don't trade. Wait till you can say to yourself, I'm ready to trade. You know, just do some breathing exercises and prepare yourself. Make sure you've planned, read reports, analyse markets. Only trade high probability trades. Create that pre-trade routine. When you're trading, take a break from the screen. And make sure that the market meets your criteria. Always make sure your stop loss is in the market. And no revenge trading. If you lose money, set yourself a time limit before you patience, and invest time to continue to learn and improve with your trading. And just a little tip, always dress as though you're ready. You know, if you're going to be at home trading, don't sit there in your pajamas. But feel as though you're in an office. Get psyched up. You've got to be in that zone. Okay, quickly moving on. That's a trading diary. If you would like a copy of this trading diary as an Excel sheet, reach out to me, info@simaxfintech.com, and we will send it to you. You know, you can customize it, make it however you want to, but it's great to keep a record of all your trades.
Yeah, because you go back all the time, don't you? And sometimes you can even say yes. That you know.
Yeah, because you know we don't learn from our good trades. We learn from our bad trades. Yeah. So why did we go into that bad trade? So on there, it's got the time you go into your trade, the details of the trade, where your stop loss is. You know, what your target was, what you actually got out at, because that can be different. The rationale, so you've got to explain why you've done that trade to yourself. And then at the end of it, I've got this, after 5 minutes after you get out, put a little arrow up, down, or sideways. And then you can use that to actually tweak your exits and your entries.
Yeah.
And I can explain all that in detail at another time for you guys. Very quickly, mistakes new traders make is a lack of research. And that lack of research and understanding of what trading really is about is the difference between trading and gambling.
Yeah. Mm-hmm.
Trading live before you're ready. Mm-hmm. You know, you had a couple of days to test on the demo account. Yeah, I'm ready. No, you're not. Trust me, you've got to prove you've got consistency in that trading over months, not days or hours. The lack of capital, again, is a massive challenge. And that's, of course, where sort of somewhere like Nordic Thunder comes in. It's great. No risk controls. You know, you're running your losses. You're cutting your profits. You don't understand risk-reward, which I've tried to give you sort of an idea on today. You're rushing into trades and over-trading. You don't have a trading plan. Or you're just chasing losses and doing that revenge trading. I said, don't do it. Setting targets. You take risks to reach that target. If you don't reach it, you're frustrated, you're desperate. Goodbye. Don't do it. For me, have goals, at that happy level, know what your costs are, know what you need to make every day. But, it's not over a day, it's over a month, it's over a quarter, it's over a year. And don't try and trade data without understanding it. Leave it to the pros. Practice it by all means on a demo account, but don't risk that money trying to trade data for a quick kill.
Yeah.
Really, really quickly, important details to have at hand, because this is the last slide. Sorry about this. Is if you are trading, if you lose connectivity, make sure you've got your broker's phone number, your account details at hand. Then phone them up, find out what your position is, what orders you've got left in the market, if any, what time your last trade is, what your current position is, and then obviously with the broker work out what you need to do to sort of counter that until you get your connectivity back. And of course, always check to see what your connectivity issues were in the first place. And the very final slide, which is very important, is our disclaimer. There is the potential risk of loss of capital. It's not suitable for everyone. Hopefully it is for you though. And just watch out with leverage, because you can lose substantially more than your initial investment. What I've provided here, everything we do is just educational purposes. We're just trying to help you become traders, but we're not going to encourage you to trade or invest. That has to be your decision. But before you make that decision, consider the risks, your financial situation, definitely your level of experience, and only risk capital you're prepared, but more importantly, you can afford to lose. Any doubts whatsoever, seek independent financial advice before you risk your capital.
Fantastic. Chris, we got there in the end. Thank you very much indeed. Sorry we had these issues, but we managed to work around it. Sorry, folks, for the technical hitches at the start of the presentation, but great content, Chris. I like it. Lots of good points there. Lots of good stuff to digest. And
also, if anybody would like a copy of these slides, again, info@simaxfintech.com. Whether you want to join our free session next week, or whether you want a copy of these slides, or you've got any questions, or the Excel sheet you'd like for trading journal or diary, then just reach out to us. We'd be happy to provide that to you. And of course, we'd be delighted to see you on our courses as well.
And don't forget, Chris will be with us at the end of April in Covent Garden for the IX Trader Show as well. So if you haven't already, use that button up there, and you can book your ticket.
And of course, guys, because we haven't got time for the questions, if you've got any questions, then again, info@simaxfintech.com. I'll answer your questions on there because we haven't got time.
Thank you so much, Chris. Great to speak to you. We'll keep in touch, and I'll speak to you again shortly. But thank you so much for joining us. I appreciate that.
Everybody.
We'll see you again soon. Bye for now.
Thank you.
So there we are. Sorry about that glitch, but yeah, Christopher, he's got a lot of really good advice to give to traders starting out, and we may have heard a lot of it before. You probably have heard of it, but it's worth paying attention to these things because it's easy to get caught up in the moment. As soon as the live trade goes on, all this good advice, it just flies out your head, doesn't it? And you don't know kind of what to do, but keep sort of hitting it home. Okay, so I'm going to remove Chris from the thing. With Sunil Mangwani is coming to join us now, accepting and connecting. Arnata, the link is for Chris. I'll post that in just a few minutes. Just really for his email was the thing, info@simaxfintech.com, but I'll post that in just a few minutes once we get Sunil in and hopefully onto the screen. Yeah, thanks for all the questions. I'm sorry we didn't get around to coming back to you directly. Okay, so hopefully Sunil will be appearing on our screen any minute. One technical snafu is enough for one day, I think. Sunil, you're here. Yes, we can just need to get you to somehow confirm the invite, and there we are. Hello, welcome.
Hi, Simon. Is audio okay? Can you hear me?
It's a little bit quiet. I'm turning my speaker up. I don't know if you can put the mic just a bit closer.
I'll try to do that. So let me see if I can get my audio a little higher.
I think it's okay. Is everybody okay with that?
Sounds good. Okay.
Oh, great. Yeah, fantastic. Yep. Okay, Sunil, thank you for joining us. I'm sorry, we're just a few minutes behind. We had an issue at the start with Chris's laptop. These things that often happen on live webinars, as I'm sure you know. Yeah. So we'll try not to get we'll try not to take too much of your time as we can. You're here to talk about. Now you are coming across to London as well at the end of April, which is fabulous. I did previously advertise this webinar as using the divergence trading using Fibonacci. Chris was talking about Fibonacci briefly there. We don't have time to go into that because that is the topic of your masterclass. But what are we going to look at today? What would you like to highlight?
It's risk management, money management policies, simple mathematics, and understanding that without money management, you really cannot succeed. That's it.
Cool. So some of the same things that Chris, but just so we get an idea of where you're coming from when you trade, because you've been trading for many years, Sunil. We've even had speakers on round the clock trade, previous round the clock traders who have trained under your guidance, have gone on to then train other. So you're spawning mentors over time as well, which is great. But your own personal strategy, I know you keep up your own active personal trading. You do what you says on the tin, and that is technical trading based, isn't it? That
it is.
You like to use the Fibonacci as your main tool.
It is, and mainly the forex market. I like the forex market because it's all technical. Your fundamentals kind of take a second place. Technicals come first. Fibonacci works excellent on that because it's kind of leading. It's more on price action. It's not lagging like the indicators.
You're right.
And of course, it's a combination of techniques, risk management, and the mind factor, something which Chris just went over right now. A lot of so I think professional traders generally know that it's your mental psychology also which is more important along with your techniques. So that's what
Yeah.
keeps you going.
I mean, that's one of the things I wonder. We're talking about, accessing funds for trading accounts. It's another thing to take into when you're trading with other people's money, albeit under one of these
Right.
agreements. Does that affect people's psychology? Does that affect the stress level? And some people don't like the idea of trading with borrowed money. Um,
It does. It does.
Something to
It
bear in mind, isn't it?
definitely does. See, there was a time when even we used to, along with a student of mine, we used to do some money management in London very specifically. But the point is, if I'm trading for myself, if I don't make money today, I'm okay with it. If I have a loss, it's my capital. I'm fine with it. When you are trading somebody's money, you're under an obligation, obviously, that you have to deliver returns. And then you tend to force trades. This is one issue which we had, even though it was going fine, but we kind of stopped it. And I prefer more of a mentorship, that I'll teach you how to do it. You do it on your own. Don't put pressure
Mhm.
on yourself. Do it on your own pace with your own money. And that's the way it works best.
Yeah, so it's even more important to stick by the rules and have these bumpers and know when
Absolutely.
things are getting out of the thing. Right, let's screen share if we may. If you remember how to hit that little icon to share your screen.
Yeah, I'll just go with this. Just give me a moment. Mm, Okay, how should I go? I'm going to share a window here. There you go. Are we okay with this?
That's great. Yeah. Okay, I can see. Yeah, maybe we'll just a we check with the people here in the room. I'm looking at Sunil's slide. It says money management at the top. Could you just let us know that you can hear and see that?
Yeah. And can I just ask you, could you just shut off my camera? Sometimes I have an issue that this because of the camera, the internet has too much of load. I might just get disconnected.
Yeah,
So if
no,
you can
it's
see the
good
screen,
advice.
that's fine. Yeah.
Great. Okay, so well, in your own time, Andy, great. Okay, so we're all green to go. So I'll let you take over, Sunil. I know you can't see the questions. If we do get any particular questions, I'll just come back on the microphone and
Yeah.
ask. But in the meantime, over to you.
All right. Thank you, Simon. And like I said, if there are any questions, just let me know. I'm just going to quickly go through this without wasting any time. Important factors over here, which I feel uh, more than the techniques, it is these factors which any trader should really know, because this is what I call as the thin line between success and failure. That's about it. Right, so we start off with you ask any professional trader the secret to success, and they would most likely mention risk management because I believe, and every trader, I was listening to Chris earlier, he also placed a lot of emphasis on the risk management and the mind factors, trade plans. So, most professional traders will tell you that the technical part, your analysis or your trading principles, trading techniques will actually take a kind of a backseat more towards these factors. According to me, money management is the single most important factor responsible for success or failure. Now, most traders are aware of the principles of risk management, but there are a lot of factors within the risk management, excuse me, and traders tend to look at incorrect factors within this. Just for example, new traders obviously tend to give a lot of priority to the win-loss ratio. So obviously having a larger number of winning trades is beneficial to the account, but there are other factors which are much more important, and this is exactly what we are going to get into with simple mathematics. That's it. So it's just very logical, very mathematical. So understanding these points will actually put you on the path to successful trading, and that's always been my endeavor. If you do a Google search today on trading systems, trading techniques, you'll come across thousands of websites, people selling their techniques. Everything's there, but there are a very few traders, you would call it mentors or systems, who will talk about the importance of risk management or even the mind factor. This is what it is, and that is more crucial to your success. And in my mentorship programs, I always start off with the fact, or in my courses, that first concentrate on your risk management, because when you are a trader, my point is you are first a risk manager. That's what you're first. You're a trader second. So that's the importance I place to money management. Now, I'm going to talk very specifically on the forex market, but this concept applies to any market that you trade. You could be trading equities, commodities, futures, anything. It's just the same. Why the statistics say that almost 80 to 90% of retail traders lose money. Now, retail traders are individual traders like you and me, who are here to make a living from the market. We are not talking about institutes, banks, funds. No, we are talking about individual traders. So almost 90% of the traders tend to lose money, and there is a reason for it. I always say it's because it's not really their fault, because they've just been led down the wrong path. That's about it. Everybody who comes here comes to make money, obviously, and if you give that trader the correct path, the chances of his or her making money definitely higher. But the simple fact is that if there is a small number of, 10% or 20% of retail traders who are successful, obviously there is a way. If somebody's doing it, then there is a way. Right? And this is what, when I started trading about 20 years back, just as a brief reference, believe me, it took me almost 4 or 5 years to become successful, to go on the path to have successful and consistent profits. I'm talking about consistent profits. It's not you have a profit 1 month and you blow up your account the next month. I had blown up a lot of accounts initially, believe me. But what kept me going was that if somebody is making money, if I know this particular trader, individual trader who's making money, then there has to be a way. So definitely there is a way. If somebody's doing it, there is a way to it. Now, when any new trader who comes in, who starts a trading journey, most assume that the way to success is to have a good trading system, a technique, the holy grail that they look for. And like I said, it's not really the trader's fault. Everybody today, you go to trading courses, they'll talk about trading techniques using indicators, and they will not talk about risk management. Right? But successful trading is not just about having a technique. It's a combination of various factors, which I describe as the three M's, which has been the cornerstone of my trading principles, which is what I just tell everybody about it. I'm sure a lot of you have heard this before, but I don't mind repeating it again and again and again, because this is very, very important. So, unless you incorporate this concept of three M's in your trading, the likelihood of success is really very low. The three M's, according to me, are money, mind, and method in that respective order. If you distribute these on a scale of, let's say, 1 is to 10, then the money, that's a money management principles, will take up 5 parts of 10. The mind, which is simply put down as patience and discipline, takes up 3 parts out of 10. The method, which is a trading technique, I mean, you could have a technical system, you could be trading on fundamental analysis, you could be trading on the toss of a coin, literally, but that just takes up 2 parts out of 10. You see, the method, the technique is the least important part of trading. Now, of course, this does not undermine the importance of technical analysis or fundamental analysis, but these techniques must be combined with the other two M's. So, a novice trader, new trader who starts the journey, usually does not understand this concept of money and mind factors, and they tend to concentrate only on the method. And within this, again, most of the people, most of the retail traders are all lagging. So there is a way to use indicators, but most of them are lagging, and that's one that puts you into real trouble. So I would say out of the 10 parts of a trading process, a new trader follows only zero point 0.5 parts out of that. And is it surprising that that new trader fails? So that trader needs to understand the correct path. What are the important points? Right. So Mind factor, this is another topic by itself, believe me. You really cannot go through it, but it's exactly what Chris had said earlier. I was listening to him and I completely agree to what he said. This, I put it down as discipline and patience. He talked about a trade plan, which is nothing but having the discipline to make a trade plan and follow the trade plan. Wait, have the patience to wait for the market to come and give you your setup. So I call it the psychology of trading. Simple facts like accepting losses. Most people don't like to accept losses, but losses are an inherent part of your trading. That's it. Maintaining a stop loss. I hear a lot of excuses from traders saying that the broker can keep my stop and I get stopped out more often than not. Well, the simple fact is that you're not doing it correctly, but you must have a stop loss. And this relates directly to the risk. you know Hoping for a trade to come back, it's in our language, we call it getting married to a trade. You're in a trade, it goes against you, and you wait and you hope for it to come back to your level. That's the first thing. Accept your loss. The simple fact is that if it's going against you, take that loss, get out of the trade, move to the next trade. That needs a lot of discipline, which is not easy. It's easier said than done. I completely agree. But those are the skills that a trader has to build up. And I always say that your mind factor is like a skill that needs to be built up. And that only unfortunately comes from experience, nothing else. Right? Other part is revenge trading. You take a loss, the next trade you go into it, you tend to risk more because you want to recover your loss. And before you know it, your 1% loss goes to 10%. So these are simple mind factors. Another time, maybe another place, we can go over this entire, you know, webinar based on this. This is also as important. But today, let's concentrate on the money part of it, right? So, as traders, we are here to make money from the market, right? What is your priority? Your priority is to conserve your capital. Simple fact, you don't have money, you cannot trade. So, preserving your capital becomes very, very important. Losing trades are a part of trading. Believe me, you cannot avoid it. It's just as simple as that. But controlling the losses becomes crucial. Now, mathematically, a single loss is not only a loss of capital, it puts you as a trader two steps behind in the quest to profitability. That's because the percent gain needed to recover from a loss increases exponentially. And this is just one chart. Let me take the middle figure over here, right? The middle figure on the left side says if your loss of capital is 50%, you need 100% gain to recover. Simple fact, if I have a $10,000 account and I lose 50% of that, I have 5,000 left with me. Now I have to make 5,000 on my existing 5,000 just to get back to break even. So I need to make 100% of my existing capital only to get back to break even, and then my profit starts. So you can see exponentially how it goes up. If I lose 5%, I'm just going to need 5.3% to get back to break even. But if I lose 60%, or let's say 70%, I'm going to need 233% to get back to break even. Simple mathematics. But it just shows you the importance of keeping your risk low. Again, losses are a part of trading. You cannot avoid it. But your job as a trader is to keep the losses low, right? So you must have a set of money management principles which will grow the account in spite of having losing trades. So there are two very basic rules of risk management, which I refer to as the golden rules of risk management. Believe me, if you follow these two golden rules, it automatically puts you in the top 10% of the winning traders. Now, these two rules, everybody knows it. I'm sure all of you even tend to follow it. But what I want to go a little deeper into this to understand the importance of why you must follow these two rules regardless of anything you do. Any instrument you're trading, any time frame you're trading, any technique you're trading, this has to be your priority. So, first and the most important one is, of course, your risk to reward ratio. You must maintain a minimum risk to reward ratio of 1:2, which means if my expected loss on the trade, when I get into a trade, before I place the order, I have my trading parameters set based on Maybe I'm using Fibonacci's based on, you could use anything, but you should know that this is where I'm going to enter the trade, that if price comes here, that's my entry. This is going to be my stop loss, and this is going to be my target. So if my expected stop loss on a trade is, let's say, 20 pips, and we're just talking about pips, points, not dollars here, my expected profit from the trade must be at least 40 pips. If it's not, yeah, we base our targets on, let's say I base it on Fibonacci's, you might base it on simple supply and demand, you might base it on some indicators. So you expect that if I'm buying this trade, price is expected to go to this level. If you see that profit is not going to give you twice of what you have risked, you should not take the trade, period. And this is where your mind factor comes in, your discipline. Avoid it. Don't take it. There'll be more opportunities. It's that important. Right? So first is your risk to reward ratio, minimum 1:2. Your second is your correct position sizing. You should not risk more than 1% of your capital on any single trade. For retail traders, I can stretch it up to 2%. That means you can have two open positions, each with a risk of 1%. Let's get into a little more mathematical detail on this, right? Just saying that these are the rules are not good enough, right? But now, importance of these is, you could have a highly effective trading strategy. I could give you an excellent trading technique, but if you don't follow these rules, your account has little chance of growing. On the other hand, if you follow just these rules of money management, your account will grow regardless of whatever trading technique that you use. And I often joke about this, believe me, that if I just follow these two rules, I can trade with the toss of a coin. You know, heads I buy, tails I sell, and I just get into a trade. And believe me, I can still grow my account. But then, right, we are not here to gamble, right? We are here to trade. We are here to follow a set of rules. Now, before we get into the risk to reward ratio, like I discussed earlier, let me just talk a little about win loss ratio. A lot of traders tend to concentrate more on this. Simple fact, like I said, losses are a part of trading. An important point is that you cannot control the losses. Simple fact is, once you take a trade, the market takes over and you are not in control of the trade anymore. The market is in control of the trade. What you are in control is the management of your ongoing trade, right? And this is where your risk management policies come into play. Now, of course, every trader wants more winning trades, and so they tend to concentrate that I need to have more wins than losses. But this is simply not true, that if you have more wins than losses, your account is going to grow. No, it will not. Right? So let's talk about the risk to reward ratio. Let's get into simple mathematics. Now, out of the two golden rules of risk management, this one is the most important factor. Let's go with simple mathematics. Now, I would always say that you measure your performance over a basket of trades. You can't measure your performance on a single trade. So let's take a basket of, let's say, 10 trades. And let's say I have a win-loss ratio of 50%, which means out of every 10 trades, I have 5 winning trades and 5 losing trades. Believe me, if you have a 50% win-loss ratio, you are an excellent trader. This is my benchmark to everybody who I talk to, say that if you can achieve 50% win-loss ratio, believe me, you're a very good trader. Don't even think about more. If you get more winning trades, it's an additional bonus. Professional traders, successful traders have a win-loss ratio in the range of between 50 to 70%. Just in that range, not more, not less, believe me. So I have 5 losing trades and I have 5 winning trades. On each of the 10 trades, we'll maintain a stop loss of 20 pips. So the expected profit from the trade should be 40 pips. Now, profits may come, they may not come. We might have a loss, we may not get a profit. Right? Let's take simple mathematics to this. So let's say that I'm following my rules and I have 1:2 risk to reward ratio. So my 5 losing trades, I lose 20 pips, I lose 100 pips. 5 winning trades, I make 40 pips per trade, so I make 200 pips. My net result after 10 trades is 100 pips. So I can achieve gains in the account even after losing 50% of my trades. All right. Let's change this risk to reward ratio to 1:1. If I have 5 winning trades, 5 losing trades, I lose 100 pips. 5 winning trades, I make 100 pips. Net result is 0. My account does not grow. Right? After 10 trades, if my account is not growing, I would say I'm just wasting my time. I'm not doing something proper. Now, let's bring this risk to reward ratio further down to 1 is to 0.5, which is what scalpers tend to do in Forex. I saw a question, somebody asked Chris a question that, trading on shorter term time frame, a longer term time frame. Let me tell you a practical point about Forex is the higher you go on time frames, the better your trades will be. But people tend to have a tendency to go to a 5 minute or a 1 minute, and you want to take 10 pips from the market, and so that you don't get whipped out of the market, you place your stop loss 20 pips away, which is fine. Now, if you maintain the same win loss ratio, in my 5 losing trades at 20 pips with a wide stop loss, I lose 100 pips. But if I have 5 winning trades and I take small profits and I get out of the trade, I make only 50 pips. So my net result comes to negative. So my account is negative 50 pips. Now, the important point over here is we maintain the win loss ratio at 50%, but the results of the trades vary drastically. So you can obviously conclude mathematically that your risk to reward ratio is much more relevant than your win loss ratio. And to demonstrate this further, let's take another scenario where I reduce the win loss ratio to 40%. That out of 10 trades, I have 6 losing trades. All right. And I have only 4 winning trades, but maintain my risk to reward ratio as per my golden rule at 1:2. Now, if you do the mathematics, 6 losing trades at 20 pips, I lose 120. 4 winning trades, if my risk to reward ratio is there at 40 pips, I make 160. I can still make a gain of 40 pips in my account, even after having 6 losing trades out of 10. And this is simple mathematics, folks. This is something everybody is aware of, but people just don't tend to concentrate on this factor, and they just get, you know, emotionally involved in the trade and throw all these out of the window, literally. Now, this is one table which I believe you should. A lot of my students, believe me, have taken a printout, and some of them have, stuck it to the desktop over there that this is what it is. It's not mine, to be honest. I picked it up from the internet. Some other company had posted it, but I thought it was so relevant. The simple fact is your win loss ratio, win rate versus risk to reward, right? If I have, as you can see, the lowest left hand corner here, if I have a risk to reward ratio of 1:5, 5 times, even with 20% win rate, I can make profits. So this is something you must look at. Concentrate more on your risk to reward ratio than on your win rate, because the win rate is not in your hand. Deciding on your risk to reward ratio is definitely in your hands, right? So maintaining the minimum risk to reward ratio becomes very crucial. But let's take this one step further. Not every trading instrument, maybe not every trading time frame can give you this required risk to reward ratio. So ideally, you as a trader has to choose the type of market that you want to trade on and the time frame that you want to trade on whether you can achieve the risk to reward ratio. And let's go into this a little. So first, there are different types of markets available. You may trade futures, equities, commodities, anything. The second is your time frame, right? A lot of us decide on the time frame on how much time I can give to the market. That, okay, I can spend maybe 3 hours a day, so I'll sit at this particular time and I'll trade on this time frame. That suits me. Or I have something else. I have a full-time job. I can look at my charts twice a day, so I tend to trade on higher term time frames. But your time frame and your market should be decided on whether you can achieve your risk to reward ratio on that particular instrument or not. Right? So let's take an example. Now, this is just trades taken in the room with the students, and the technique I'm following is just the divergence. We'll talk about it very briefly over here. And the entry stops and targets are decided by Fibonacci levels. So what we do, my primary trading technique is the divergence, which is something called the class A divergence, which is one of the most effective forms of divergence. And we set our entry stops and targets based on Fibonacci's and a combination of supply demand zones and everything. So even before I enter the trade, I know that this is my entry, that's going to be my target. maybe 1, 2, 3. I mean, if Forex has a tendency to run, right? Advantage of trading Forex is it tends to trend. And sometimes if you get into a trade which can really keep going, you should be able to milk that trade to your advantage. So just as an example, this was a trade on the 4 hour. I've just put down the figures over here. My risk was 60 pips on this particular trade. My reward on the first target was 290 pips. So my first target gave me a risk to reward ratio of 1:5. Second target, I had put it beyond that. If it goes, had a risk to reward ratio 1:8. And my third target had a risk to reward ratio 1:10. Right now, this is a 4 hour. Like I said, higher you go on time frames, you can tend to get better trades. Now, the same concept of divergence, let me take it on Forex on trading on a 1 minute chart. The concept remains the same. My entry risk to reward ratio over here, my risk was 3 pips. Believe me, it's 3 pips is nothing. I probably get whipped out of the trade before even I know it, but I'm just following the rules over here. My reward was 8 pips. My risk to reward ratio was 1:1.6, less than that. It's the magnitude of the move. The lower you go on time frame, the lower is the frequency of the move. So if I'm going on a smaller term time frame, I am not achieving my risk to reward ratio. So conclusion, I must stick to larger term time frames, especially in Forex, where I can achieve my risk to reward ratio. Right? So higher the time frame that I trade on, larger will be the risk to reward ratio. Now, based on this, let's go over one more mathematics, right? Now, in this trade on the 4 hour, we achieved the risk to reward ratio on the first target of 1:5. Now, based on the table which I showed you, if I have a win loss ratio of 20% and I have a RR ratio of 1:5, my 8 losing trades will give me minus 160 pips. 2 winning trades at 5 times 100 pips each will give me 200 pips. After 10 trades, after losing 8 trades out of 10, I still gain in my account. Now, this is the importance of your risk to reward ratio. And believe me, I have come across situations where I have got a streak of losing trades, about 5 or 6 losing trades in a row. This is what the market gives you. Yeah, when you become confident and you say, "Oh, I'm a good trader," and the market turns around and gives you a good kick on the backside and say, "Oh, you think you're smart? Oh, well, here you go." Right? So your job as a trader is to be prepared for those scenarios. Okay, now let's go if I'm trading the futures. Now, I always say, if for traders who come to me and they say that I want to trade on the 1 minute in Forex because I want to take small profits and get out of the trade. The market is moving all the time. It's a 24-hour market. My advice is, if you want to trade on smaller time frames, go to the futures market. It's a much better market to trade on smaller term time frames. Forex, you will not make money. So this is an example of a similar divergence with the same magnitude of frequency of the price, but achieving a risk to reward ratio of 1:3. This is a crude oil divergence spotted on crude oil on a 1 minute time frame, but you are achieving the risk to reward ratio of 1:3. So in futures, you can trade on the 1 minute because you are achieving that. I'm taking an example of equities. This was one I was consulting with one client. They're a fund based out of Dubai. And I had given them this on a weekly time frame, the WFC, right? This is Wells Fargo. This, of course, some way back, about 3, 4 years back, sometime 2 years back, I believe it was. And this was a bullish divergence which I had spotted. This was a chart image taken before we got into the trade. This was the advice that this is expected to go up. This was on a weekly time frame, and this is what happened. Price went beyond target 1. It did not go to the target 2, but we achieved a risk to reward ratio of more than 1:3. So when you're trading equities, obviously you need to go on larger term time frames, somewhere where you can achieve your risk to reward ratios. Right? So your risk to reward ratio should define your trading time frame. Maintaining the minimum risk to reward ratio 1:2 is crucial, and you must select a time frame that will offer this. Obviously, trading on larger term time frames is advantageous because you can capture larger movements and increase the risk to reward ratio. Simple fact is, if instead of 1:2, I achieve 1:4 or 1:5 on my trades. I'm doubling, quadrupling my profits four times on every trade. It's just simple mathematics. All right, folks. So this was your risk to reward ratio. Now, your second golden rule is your correct position sizing. And as we said, you should not risk more than 1% of your capital on any given trade. Stretch it to a maximum of 2%. I can even say 3%. I can go up to 3%. I do have three open trades sometimes, each with a risk of 1%. Right now, let's understanding what position sizing means, because in Forex is based on leverage, absolutely on leverage. All trading in Forex takes place on leverage. Your broker by default gives you a leverage, right? So you are risking a small percentage of the trading capital. That's your position sizing. So what exactly is leverage? In Forex, high levels of leverage are available everywhere. Even in any kind of instruments, you have high leverage available to all instruments. Your broker is more than happy to give you, as per law. They've clamped down a lot about the maximum leverage that a broker can give you. But if given the choice, your broker would probably give you large leverages, right? And we'll get into this. But as they say, leverage is a double-edged sword. While the use of leverage can increase profitability, which it does, it also puts the account at high risk, and correct position sizing becomes important. Believe me, I have seen new traders, blow up their Forex account in one day only because of the use of high leverage, which they do not realize it. So, the fundamental definition of leverage is use a small amount of one thing to control a larger amount of something else, right? So, in financial markets, effective leverage is how many times you're leveraging your money, your capital when trading. As I said, allows for strong potential returns, but can result in significant losses. Now, leverage is directly related to margin, right? When you utilize leverage, effectively the broker is lending you some money to take a larger position. Now, if your broker is lending you money, obviously he needs some security for the funds lent to you, and a certain amount of your capital is blocked for the trade. Now, this is an important point which I find a lot of traders are not aware of. So, margin, when you take a trade, there is an amount of your capital which is blocked. So, this is a security deposit kept aside for the duration of the trade. All right. Now, once you close the trade, this security deposit is returned to you regardless of whether your trade is a win or a loss. It doesn't matter. It doesn't matter to this margin. It's returned to you, and of course, your broker doesn't give you any interest or anything of that, but your deposit comes back. So it's your money which is just blocked for a certain amount of time. If you do not utilize any leverage, there'll be no margin. And another important point is, let's say your broker gives you, or you are offered a leverage of 50 times, which is the max today, I believe, in Forex. So as per FCA today, they don't allow you more than 50 on major pairs. On cross pairs, I believe it's 30. If my broker gives me a leverage of 50, I can ask him to reduce it. Right? I can ask him, I can say that I don't want leverage, or I want a leverage of just one time. It's going to affect the amount of capital that I put in as margin, but I can change it. He cannot increase it, obviously, as per law, but he can reduce it if you ask him to. But we'll go around this. I'll give you a cheat sheet around this, all right? So there is a mathematical formula. Your margin is calculated by the rate of the currency that you're trading right now into the lot size, whatever is the lot size that you will be or you are into the trade, divided by the leverage available to you, right? So just simple mathematics, like I said. So if I'm utilizing a leverage of 10 times, and if I'm buying 10K, that's 10,000 units of euro, 10,000 units is one mini lot, as we call it, at this rate, the margin that I would keep with the broker if I'm using a leverage of 10 will be about $1,000. Now, if I'm using a leverage of 50, by the same calculation, the margin that I'll keep with the broker is only 200. Now, this is what entices new traders to go in for higher leverage, because in Forex, unfortunately, what you can is you can even open an account with $100, right? Let's say I open an account with $1,000, and if I'm taking a leverage of 10, I don't have that much money to keep aside. My entire capital is blocked up in margin. So obviously, I'll go in for a higher leverage. So I only keep aside $200 with my broker, which I cannot use. I still have $800 to use, maybe to take another trade. So I'm tempted to go in for a higher leverage. This is the basic concept of why traders tend to take higher leverages, because they don't understand the downside of utilizing high leverages, right? So the use of margin is correlated to your capital. Now, if your equity is small, the trader tends to use a higher leverage to reduce the margin amount. This will enable to take the trade to take for the trader to take more trades with high leverage. But the simple fact is, if I'm utilizing a leverage of 50, I am sorry, leveraging every move in the market by a factor of 50 times. A 1% move would equal to a 50% increase or decrease in my account equity. And this is where most traders don't understand this concept, that even a 1% move, and in Forex, a 1% move is like a walk in the park, literally. It can increase or decrease. Increase also, you can make huge profits, or you can blow up your account, right? And as a trader, my point has always been that I will look at my losses first, and I'll look at my profits second. Right. So there's a strong relationship between the leverage and its impact on your profitability. Greater the leverage, greater are the swings to your equity. Smaller the leverage, smaller are the swings. Now, conservative traders, professional traders, believe me, do not utilize a leverage of 3 times. Even retail professional traders usually go in for a leverage between 5 to 10 times. But let's go over one important factor. If I am following my golden rule and I'm risking 1% of my trading capital, effectively my leverage automatically comes in the range between 5 to 10. Depends on the currency that I'm trading, the value of the currency, of course, but it's always between 1 to 10. So you see, what I can do is, if my broker is giving me a leverage of 50 times, I'll utilize the leverage. I'm going to take the leverage, which simply means that my margins are going to be smaller. So I still have some capital left with me. At the same time, I'm going to risk 1% of my capital. So my leverage automatically falls into place. So I get the best of both worlds. So the importance of following your position sizing has a double advantage over here. Now, this is one, again, I picked it up from the Daily FX. It's a good resource for a lot of data on the Forex market. And here you can see traits of successful traders depending on the leverage. So the traders who used a leverage of 40% is less than 5 times is their winning percentage. And traders who used a leverage of about 17%, their winning percentage is more than 25 times, right? So I'm sorry, this is the other way around, that I'm using a leverage, but this just proves the point that my profitability is higher. I mixed it up, my mistake. My profitability is higher the lower the leverage that I'm using. And these are based on statistics, all right? They're just based on the volumes that they get out from the market. So this was the importance of your risk management. Now, the third M, we went over money. We very briefly went over the mind factor. The third M is the method. Whatever method you follow, I always say that something which should be effective, something which should be easy to follow. Don't make it complicated. Don't use 10 different indicators that you yourself get confused. I follow the divergence as my primary trading technique, which when I will be in London for the IX Investors Show, we are having the masterclass based on this. Now, this is based on the concept that institutional traders create traps for retail traders. And within divergence, everybody knows what a divergence is, but most people are not aware that there are 3 types of divergences. There is a class A divergence, there is a class B divergence, and there is a class C divergence. We follow the class A divergence, which is one of the most effective ones, and is based on the concept that institutional traders create traps. Now, there's something which I have gone over in some of my earlier webinars. I had the fortune, I would say the good fortune, some years back in London to do some training for a bank, right? So I was on the trading floor of a bank, and it changed my whole concept of trading because now I was on the other side and I saw how the banks can manipulate the markets. I won't say manipulate, it's not a right word, but they can move the markets only to take out the stops of the retail traders. That's what they do. A bank trader, now this particular branch was probably trading about $10 billion a day in the forex market. They had a forex desk for about 5 to 6 forex traders, and the reason they would place their orders at certain levels is only to the concept that they know retail traders are going to come here and this is where they're going to stop them. It just goes simply to the fact of supply and demand, right? If a bank wants to buy something, what does he need? He needs sellers. So he is going to move the market to trap retail traders to get into sell trades. And the more retail traders get into sell, who is going to buy those sell trades? Is a bank who's going to buy it. And this is how it works. So this is just based on how the market works on supply and demand, very specifically to Forex for every instrument, right? And this is a class A divergence which works on this concept. It just, again, this is one image which I picked up from the internet, not mine, but I really liked it, is that you have this cluster of stop losses. So you have this support level which is probably being tested maybe once or twice earlier. And when price comes back to it, a lot of traders will want to go long because they expect the support to hold. And obviously, they'll keep their stop losses below the support level. The banks will drive price down over here. You see this long wick, take out all these stop losses, net all the fishes as the small fry fishes, which I always say that we are small fry when we're trading in a forex market, and then the price goes up. This is what makes the method more effective, if you can understand. So what we are doing here is we are aligned to the professional traders. We are aligned to the banks, to the big money, and when they move, we want to get into the trade, which is what makes it more effective. And this is just one trade example I just put across again of, so the divergence takes place because you did have price having a resistance level over here, breaks the resistance level, takes out all the stops, and then comes down to your actual move. So this is just what divergence is. Again, we are not here today to talk about divergence. Right, so I think this was about it. Done with it. If for further information on the webinars we do, the workshops I do, I conduct personal mentorship programs, please visit my website. And of course, I would love to meet you personally at the IX Investor Show on 28th April. I will be there. Feel free to get in touch. This is my social media, my Twitter, LinkedIn. I have a YouTube channel where there's a lot of good information on YouTube videos and trading systems, effective such. This is my email. Feel free to get in touch with me anytime you want. I'm always open to questions. I'll always reply back. And of course, if you want a copy of this slides, you can definitely ask Simon about it, and he should be able to give that to you. So that was about it. All right, folks.
Fantastic.
Yeah.
Thank you, Sunil. Yeah, we've still got a few minutes here. So if we've got any questions for Sunil, we can address these. The kid says, thanks, powerful overview. Thanks for that, the kid. Finn Toro are here, which is great. You can ask questions post-event tagging at IX Investor on Twitter. Great point, Finn Toro, keeping me right when it comes to social media. Thanks for that, Prav. You must be there. Here's a question: what is your favorite time frame in Forex, Sunil?
That's a very interesting question. My favorite time frame is the 4 hours. I find that to be a good balance between the professional traders who trade longer term and retail traders. So with the 4 hours using multiple time frames, I can go down to the 1 hour, decide on my trading parameters over there, and it's not too low a time frame, it's not too high a time frame, so I'm aligned with the professionals. At the same time, my trades don't last too long, I don't hold them for months together, right? So 4 hours, definitely my preferred time frame.
There we are. Yeah, yeah. Are you still doing weekend shifts for the NYPD then, or
Actually, come to think of it, right now I have a session with the US in about 10 minutes with the US company, and one of my students is an NYPD detective, the one who gifted me this one.
wow? There we are.
And she's been a trader for 4 years, and she's consistent, she's still stuck onto it, a hardworking woman and doing good.
And keeping you in good clothing as well, which is
Yeah, absolutely. Advantages of having a good student.
they call it a pockle in Scotland. Yeah. And just to come back to that, do you also use multi-time framing? Oh yes, we
I
talked.
think I just
Yeah.
answered the
In
question.
the last question.
Multi-time framing becomes very important because you want to get aligned to your higher term trend. And let me tell you one important concept about multi-trading. Now, free advice, as I always say. If I'm trading on the 4 hour, I would look at the 1 hour, on the daily on a higher term time frame to see if there are any barriers present. That's more important. So let's say I'm going for a buy, I'm going long. And if on a daily time frame, maybe a supply demand level, a supply level, or a Fibonacci level, if it's very close to where my price is, that means the price does not have much room to run. So I'll be more careful about my trade. And that's more important, looking at your larger term time frame and keeping your trades in perspective.
Okay, I'm just following the kid's question. If you hit the rate of return at £1,
Okay.
yeah,
1:3. Yeah, fair.
how do you it's trailing or straight exit?
Trade management is very personalized. My personal view on this is I will go in with 1% of my capital. As soon as I reach 1:2, I'm going to take away at least 25 to 50% of my profits and move my stop to break even and leave the rest to run. If it runs, if I'm in the trade good enough, if it doesn't, at least I have walked out with 50% of the trades. So I have always protected my profits. My main concern is my winning trade should never turn into a losing trade. So trade management, very important. Take your profits as and when you can, but at technical levels, not because when you feel like it. All right.
Fantastic. Okay, any other questions for Sunil this morning? We've gone on a few minutes, or have we covered everything? You're coming over to London, which is great, Sunil. We're going to do. You are doing a 3 hour, well, a morning
Yeah.
masterclass
Yeah.
event, so 3 hours, maybe even, but a bit,
Right.
longer if you need the time. What do you cover on that? It's the divergent trading divergences in using Fibonacci. Could you tell us just a wee bit?
Yeah, it's like I said, it's based more on the concept that your institutes are trapping the retail traders. We want to remain in the direction. So the 3 hours covers basically, we start from the beginning, introduction to the Fibonacci levels, how to use them correctly, how to plot them correctly, which are the effective ones, understanding the class A divergence. Divergence, like I said, you do a Google search, everybody knows what divergence is. But understanding what a class A divergence is, putting down the conditions that only if this happens, this qualifies for a class A divergence. Then get into your trade, get into your trading parameters. This is my entry, exit, and target. Risk management factors put in, money management and trade management rules put into the trade. If the trade goes in my favor, this is what I'm going to do. If it goes against me, which it can, this is what I'm going to do. So it's the entire trade plan based on one system.
Fantastic. One question there from Udurindi. I hope I'm pronouncing that correct. what is your best trading strategy? Very simply.
Oh, I think I just answered the question. It is divergence as
Is
far
that
as I'm concerned. And because I have been using it for a number of years, I've seen the effectiveness of it. And there are a lot of factors which have come up recently. A lot of traders, we talk about break of structure, talking about price action. Divergence fits into all of this. So it's a break of structure. At the same time, there are trap levels. At the same time, we've got very strong checkpoints for a class A, saying that if this happens as a class A, if it doesn't happen, we don't take the trade. So yeah, that's it.
fantastic? Okay. So Neil, thank you for joining us. It's been
All
good.
right.
One final question, Seb. Any recommendations for brokers? I know we don't really like to do this because
Uh,
there's brokers and brokers, and uh,
not really. I wouldn't really put a, a name on somewhere, but just go to see to it that they are regulated by the FCA in London. The FCA is the strongest regulatory body.
yeah.
If they are regulated by FCA, they have to be a good broker. They don't give you too much of leverage. Your funds are kind of safe, kept in a segregated account. That's the first condition. Second, of course, a lot of competition nowadays. See that you get a good commission rate or spreads, thin spreads. One broker that we do deal with, last time we were there in London, and I believe he will be there at the IX Investor Show, is Trade Nation. You can talk to them. They are good people, well regulated, excellent brokers. You can have a look at Trade Nation. So, but that's it. Yeah.
Okay, fantastic. So Neil, thank you so much for that.
All right.
Thank you on behalf of everybody here.
Yep.
We're going to pull it back. We're going to change into the new the new webinar. We've got Ross Maxwell from Keyzone Traders coming up. So what I'm going to do is to shut down the session and pull people into the new session, which we haven't done so far today. So thank you
Okay.
so much, Neil. Enjoy your day.
Yeah. Thank you very much. Thank you, folks. And get in touch if you have any question. Thank you, Simon. Always a pleasure being here.
Fantastic. Okay, let's enter
Okay.
the new session.
Yeah. I still have one more session to go.